Although they do still talk about a tight labour market, they don't expect that unemployment is going to rise meaningfully over the course of the next year or so.
Sarah Hewen, thank you so much for joining us today with Standard Chartered Bank. As we move forward here, and again, I've got sterling folks here at a 126.08. That is an advanced, stronger sterling here as we've seen over the last number of weeks, and some real nuances here in the change, and it brings it back to the 8:30 data in the United States.
Before we get there, Sarah said something really interesting, which is partly that this unexpected boom in growth is because of what's happening globally. How much of that is because of China and the sort of accelerated schedule of reopening in addition to lower oil prices? This, to me, is an interesting one, especially because overnight there are some questions around just how much China really is expanding, that there is some sort of questions around credit creation and things aren't really going as quickly as possible. So I just wonder that sort of uncertainty, how it's hanging in there.
Some of it, to me, is the pandemic. Now, you've got a war in Ukraine, and really, Greg Vallier's note this morning on Ukraine was just outright shocking about the dynamics there as we go into spring and summer military offensives. But, okay, that's there. But to your point, out of a pandemic, so much of this is still unpredictable. And I would suggest in the over-analysis of what we do in financial media, the mystery here into the summer is far greater than maybe we perceive.
It's been a mystery for months and months. And to your point about the data that we're getting at 8:30 a.m., yes, we get PPI. We also get initial jobless claims. Do we see the same kind of trend in the U.S. that we see in the U.K. about the labor market remaining much stronger than people expected, a dearth of workers? And that really was what people were saying. It's adding to a stickiness of wages and a strength, frankly, in the overall economy.
I have enough respect for a lot of our guests that really matter about weekly data like the claims, even though it's one-sided, it's claims, and continuing claims maybe has a new value here. But the 4-week moving average is from 191,000 expanding out to more claims now of 239,000. And I'm sorry, that's like legitimate math. That's a trend. And I'm hearing all in 250, 270 is maybe where we begin the surveillance sweat. We're just not quite there yet.
Exactly. It's ticking up, though, at statistically significant rates, but off such a low base that it really, again, talking about that mystery heading into the summer months that we keep talking about, is this just a very messy process.
We'll continue to analyze what the Bank of England does and, of course, the comments of the governor of the Bank of England. But we turn to the United States, and in Paris, our Francine Lacroix with James Dimon of JP Morgan. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Donald Trump is urging Republican lawmakers to either get President Biden to agree to spending cuts or push the U.S. into its first ever default. The former president spoke in a town hall event with CNN in New Hampshire. He holds a tight grip on the Republican Party, and polls show him as a frontrunner for the party's presidential nomination. For a third day, Israel and Palestinian militants in the Gaza Strip exchanged fire. Islamic Jihad squads launched more than 500 rockets toward Israel. Meanwhile, Israeli aircraft killed the group's chief rocket maker in Gaza. Efforts to reach a ceasefire have not worked. Ukraine needs more time to launch its long-awaited counteroffensive against Russian forces, and that's according to President Volodymyr Zelensky. He told the BBC the army is still awaiting some promised aid from allies, such as armored vehicles. Shares of Disney are lower in pre-market trading. The world's largest entertainment company posted a drop in subscribers to its streaming service, Disney+, and it predicted a bigger loss in the business this quarter. Disney says the loss from streaming will increase by $100 million because of shifting marketing costs. Bloomberg's learned that Saudi Aramco is pushing back a deal that would have been one of the largest share sales this year. The company is delaying the planned IPO of its energy trading business. It may be pushed into 2024 unless the market improves. Aramco was considering seeking a valuation of more than $30 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Today, Bloomberg continues its coverage of the J.P. Morgan Global Markets Conference in Paris with an exclusive interview with J.P. Morgan CEO Jamie Dimon in the wake of the bank's purchase of First Republic. Join Francine Lacqua at 8:15 a.m. Eastern as they discuss the banking crisis, taming inflation, jobs, and more. It's all happening live on Bloomberg Television and Radio, your global business authority.
The default on U.S. obligations would produce an economic and financial catastrophe. Millions of Americans could lose their jobs. Household incomes would be reduced. American businesses would see credit markets deteriorate. And millions of American families that receive government payments would likely be left without the resources that they were promised.
In Japan, on the west coast of Japan, overlooking Korea and Russia, the Secretary of Treasury of the United States, steeped in the dynamics and history of American labor economics, that is Janet Yellen. Anne-Marie Horton, in conversation with the Secretary of Treasury from Japan. Look for that. We're going to do this in real time, 3:30 New York time in the morning. Only Bramwell will see that. I'll still be in a surveillance slumber. London, primetime morning, 8:30 a.m., and of course, the afternoon down south from Japan in Hong Kong. Really looking forward to that. It's going to be really quite interesting.
Especially given the tenuous nature of having to deal on an international stage at the same time that domestically, you know, this is a real issue with the debt ceiling debate. I know you hate this thing. Everybody hates this thing. And I feel like Washington is doing its best, as you said, to get everybody's attention, to say, we need the attention, all eyeballs on us. We need the drama. We need the political theater in order to get something done. And people just aren't budging.
We'll have to see. And, you know, frankly, our next guest, I think he takes, I don't think it's the same vacation days that the politicians take.
No, I think that he's in the office a little bit more. But we have this debt ceiling deadline. As our next guest, Michael Zezis of Morgan Stanley, calls it. It is a moving target. He adds, we pay particular attention to what happens if the X date is crossed, a meaningful risk. While we maintain as a base case that default will not occur, even if we cross the X date, markets have to contend with an elevated probability of default and or economic downside in that scenario, something, Tom, that markets just aren't doing at this point.
Michael Zezis is one of my favorite people on this. He's got parchment from Georgetown. That's on the flight path into Reagan, if you're not familiar with it. And also from LBJ, and it's a really wonderful mix, of policy analysis during this debt limit crisis. He is with Morgan Stanley, head of public policy research, global head of fixed income research. So, Michael, just thrilled to have you on today. Is this for real? Is it a crisis?
Well, it's for real in the sense that we need to take seriously the idea that we do something we haven't done before, which is cross the X date. The X date being that day after which Treasury doesn't have enough cash on hand to pay all of its obligations as it comes due. That in and of itself doesn't tell you that there's going to be a default. Again, I would argue we're probably not going to default because there's a lot of options that take default off the table even when you cross the X date. But those options aren't particularly good, and they're not particularly good for markets. You're talking about payment prioritization, for example, where you take roughly 17 to 18% of income out of the economy because that comes from transfer payments from the government. You potentially also use something like the 14th Amendment, where the White House can decide we're just going to pay the debt anyway. But the problem then is that you just set up another kind of judicial crisis and you create a substantial amount of uncertainty. So the options aren't good if you cross the X date. And that's what we really have to pay attention to.
Lyndon Baines Johnson would not have done this. You studied at LBJ at Texas, and you know, I think we all yearn for how LBJ could get heads together, knock them together, and say nobody's leaving the room till we fix that. Is there an LBJ out there in Washington to get this done?
You know, I wouldn't pin this on a person. I think this is really about the moment and the pressure, right? So another potential outcome here is you cross the X date, and because the reality of what I just described becomes so self-apparent to voters, to businesses, to anyone who is a vendor of the government, that the political pressure becomes so immense that it effectively forces everyone to the table. It forces some level of compromise. That's probably more what it takes than an individual personality at this point.
Last night, we were talking about individual personalities, Michael. Former President Trump, in that CNN town hall discussion, talked about actually encouraging a debt default if there wasn't some sort of significant spending cuts agreed upon, saying that basically it could be maybe nothing if the U.S. were to default on its debt. How significant would it be, in your view? What are the market risks that could emerge?
Yeah, listen, I would not downplay the idea of default as something that the markets could just kind of whistle by, right? You're talking about, and Secretary Yellen talks about this already in terms of the interruption of credit flow. If all of a sudden banks are loaded up with non-performing assets, i.e. treasuries, there's going to be some impact on lending. And of course, there's already been an impact on lending through the issues with the regional banks. So that would obviously be a pretty substantial problem. And all this leads to whether or not you actually go there, right? I think it's far more preferable for the White House to do something like use the 14th Amendment to either keep paying the debt or do payment prioritization. But all of that leads to economic downside and uncertainty. It's just different flavors and different degrees.
How do you game out that a recommendation for people in terms of gaming out the degrees and flavors of some sort of economic deceleration and where the likely spending cuts at the very least will come from?
Yeah, listen, I think ultimately a compromise is probably about limiting potential future spending growth and limiting potential future deficit growth. That type of austerity might impact markets in the sense that we're already in the middle of an economic slowdown. So to the extent you need to mark your GDP forecast numbers a little bit lower for some of that deficit shrinkage impact in the next year or two, that might matter. But ultimately, that type of compromise probably only matters in a marginal sense because, of course, the next Congress could come in and easily undo all of that.
Michael, wrap in here all of your world-class fixed income analysis. Jeff Weniger over at Wisdom Tree just trots out a chart. I think you've got a tattoo on your left arm of it. It's interest payments by the government. Let's call it $500 billion. And dare I say they may click through $1 trillion here if rates keep going up. Is interest payments that the government's making to you is the adult in the room, are they getting out of control?
Well, I think this is really a question of, it's not a question of interest payments too high or they crowding out other spending. It's really a question of whether or not inflation is a problem because, of course, the government always has the ability to source, if it wants to source the dollars it needs to pay its debt because it's creating those dollars. The question is really about inflation. That's the real constraint, right? So unless you believe that the Fed is not axed to bring down inflation or doesn't have that capability, this conversation is a bit of a sideshow in our view.
Michael, thank you so much. Michael Zezas with Morgan Stanley this morning on a debt ceiling.
Thanks for having me.
Again, and Anne-Marie Horton will be with the Secretary of Treasury here tomorrow as well. What's so important to me here is you look at the CBO, the Congressional Budget Office. Lisa, I can't say enough about the quality, the bipartisan quality of the Congressional Budget Office. And what's interesting there is their GDP guesstimates out 10 years. And this folds right back to the Bank of England, which is the key headline today, is they're sort of saying like Citigroup, oops, the Bank of England got wrong. What a cautious view on a recession to come in the United Kingdom. And that folds back into, okay, what's our guess out 1 year? dare I say 3 years, 10 years out, good luck with that.
Well, and how do we understand what debt load is sustainable in terms of a proportion of GDP if you are growing at a faster pace than expected or a slower pace? How do you game this out at a time of such incredible economic uncertainty with these projections key to the fiscal stability of the nation?
My book of the summer, I'll put it out on Twitter. I haven't done that in a couple weeks here. Olivier Blanchard's monograph here on all of this, the R-starred minus growth analysis. And he's heated that there's things we don't know about 10 years out, like technology.
One thing we do know are some of the earnings that are coming through. Luxury just keeps crushing it. I think this is fascinating. Prada, I thought you'd find this interesting, first quarter coming out with retail sales rising 23% because of Europe and Asian sales. Again, this to me, how much is this people spending and how much is this the bifurcation between the haves and the have-nots and the people with plenty of discretionary
And it goes
spending?
to the China opening, which is really under heated debate, even this morning. We're an hour away from important American economic data. Jamie Dimon and his team at JP Morgan Economics will be paying attention to that after his conversation with Francine Lacroix. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Bloomberg Surveillance, Jonathan Farrow on assignment, Lisa Bramwitz and Tom Keene here. We've really got to get back to block and tackle data markets and markets movers now. We've got big events coming up. Amory Horton in Japan with Secretary Yellen tomorrow. James Dimon with Francine in Paris here in about 45 minutes. Forget about fancy conversations with fancy people. Markets move. We get a retreat here off the green on the screen. The SPX now slightly negative, but the yield space is important. The 2-year yield is broken down 3.88%. That's in 3 basis points and really begins to threaten what we saw all the way back to May 5th. So we're seeing a dramatic move there from a 405 down to a 388 on the 2-year yield. We continue to watch at the 10-year. Excuse me, the 10-year yield 3.40% as well. Oil, a little bit of a pullback as well. Gold, 2,043, up $7. That gets my attention. Dollar giving me not much of a story this morning. We'll have to watch this very, very carefully. And what's important here is to get to the movers. There's a big mover out in Anaheim, and there's other movers of the banks that are funding the trips to Disneyland as well. What do you got of movers today?
Well, let's talk Disney first. The shares are lower after we saw what happened with respect to their earnings. They do expect fewer than expected subscribers for the Disney Plus platform, also a wider loss. Those shares lower by almost 6%. The concern here is how quickly can you ramp up streaming as advertisers really pull back from cable, from sort of the classic television streaming networks rather than the bespoke ones. Robinhood shares, they are up 3.9%. They beat. They had better than expected results, and people are looking forward in terms of product innovation and
please, I'm asking,
profitability.
what is product innovation at Robinhood Markets Inc.?
It will scare you. 24-hour trading in ETFs.
I thought your kids were doing that already.
Exactly. Well, in other words, if you think that Bitcoin is the only thing that trades all the time, it is not anymore, because evidently they're going to have something that goes all the time.
$9.42. Is it a meme stock still? Well, I'm not very memey. I'm up speed.
It had been, because it had been fluctuating so much, and because it had been sort of the stalwart representative of individual traders. Whether it becomes that way, perhaps. I really do want to get to PacWest. It is actually probably the most important story of these particular stock movers. Those shares lower under $5 a share, $4.83. And this comes after, get this, they said that deposits declined by about 9.5% during the week ended May 5th. The majority of that decline occurred on just 2 days after news reports on the afternoon of May 3rd about potential strategic acquisitions, et cetera. They also talk about potential sales of assets. And get this, the line that no executive ever wants to have to say. Yeah. They believe the company has enough cash to fund its needs over the next 12 months. Not what you want.
$4.78 intraday low, 4.33. I'm sorry, this is on Mr. Dimon's radar. He's not going to tell Francine Lacroix that, but the Keefe Bruyette Index, which is not just PacWest of the world, I'm not going to call it a dead cat bounce. It doesn't even deserve that accolade. It's just sort of kind of like.
And JP Morgan has played a role in some of the banks that have had some issues, including First Republic. Taking a step back, I'm curious how much the Blackstones of the world are going to take some stake in some of these shares. There was a story out today about Blackstone getting more engaged with regional lenders and coming up with some funding programs. But the bigger question is still, are we out of the woods with the smaller banks? Is this idiosyncratic at a time when it's being pressured by a very real rate structure?
And everyone out there looking at this, every strategist, whatever their remit, looking at the banking debacle as it unfolds. Thomas Satoris is head of fixed income research at Strategas, a Baird company, and joins us this morning. You have the advantage of down the hall is one Jason Trennert, looking at the equity market, folding in the JP Morgans of the world into your fixed income analysis. What is the Strategas view on the length of this banking crisis? Does it get fixed?
What's your definition of fixed? Do we have more bank failures along the way? Probably. Does it become a systemic risk, particularly to SIFIs? Probably not. Does it become a risk to super regional banks? Probably not as well. But is there incremental credit tightening to the U.S. economy from this? ahead of us? Absolutely. And with monetary policy acting with the lag, we have to assume there are more shoes to drop here and more banks to fail.
Which spread, a comparison of two yields, is most valid to you to get the temperature of PacWest and other banks? I'm looking at 3-month, 10-year, but there's debt ceiling issues in that as well. Which spread tells the best story?
Well, 3-month, 10-year might be a better measure for banks because you're looking at funding cost relative on the front end of the curve versus their essentially what are they potentially getting for yield for new assets they might be purchasing. But I don't think anything really gives you a good picture of how much their net interest margins have compressed over the last 2 years. I mean, those are probably 0 to negative at this point in time, given where they bought those assets. Those long duration assets might have been bought at a yield of 2.5%, and their funding costs today might be 4.5 to 5.25%.
This is a really important point, that we have moved from just simply deposits being there to even the deposits staying are going to be a problem given how much they're going to have to pay to keep them. From your vantage point, what are you expecting in terms of the number of failures and the ramifications for monetary policy and broader market conditions?
Well, probably low double digits, maybe high single digits, so maybe not many more to come, and fairly small in size. But you got to remember, though, that's the norm over any given 2-3 year period in the past. Keep in mind, from 1980 to about 1992, we had over 1,000 bank failures. In the last dozen years, we've had about a dozen failures. So you can say we're overdue. So the norm might be 2 to 3 per year on average.
Well, but this is the question, right? If it is just the norm, is it not setting any alarm bells? Doesn't change anything with respect to the rate hiking cycle, and doesn't change anything with respect to your approach to what you invest in?
Well, let me answer this from the Fed's perspective. This absolutely should change their perspective and what they do going forward. You have monetary policy acting with the lag. You have multiple bank failures, and you have, at best, multiple banks are going to be in negative net interest margin for at least the next 12 months. That's a reason to pause right there. Mission is not accomplished on inflation, but that's a good reason to pause tightening to see how the incremental tightening from the credit tightening that is to come plays out. You may end up having to hike again in the future, but this is a good opportunity to pause.
Brief us on James Dimon coming up here in 45 minutes as well. This conversation is frankly just as important because you're in the trenches looking at the ramifications of a trust in the J.P. Morgan company, or frankly, Bank of America, to save the day. Are they going to come in and have to save the day again?
I don't think they're going to have to. Whether they do come in and make additional plays here, that I can't speak to, but I don't think they're going to need to. I think that this is a system that essentially your super regionals are in good standing right now. Your SIFIs are in good standing. You're talking about smaller banks going forward. There's going to have to be consolidation in the regional banks. Some of them may be bought. I
don't mean to interrupt, but this is an important nuance. Within a bidding process where the government's forced to take the low bidder, or just in a normal M&A context?
Both. You could have additional failures where there are essentially negative net asset values there that the government is forced to take the lowest bidder. But you should also be expecting going forward to see typical M&A where some regional banks consolidate and become super regionals going forward. And even some super regionals may grow themselves to breach that SIFI threshold. That should be the expectation going forward. The reality is I think the U.S. banking system is migrating more towards what you might have in Canada or Australia, where you have a few very large dominant banks. It's not going to be 3 or 4 like you have in those regions. It might be 8 to 10 in the U.S.
Let's dovetail this question about financial stability into what we're going to get in about 50 minutes, which is the latest read on inflation as well as the labor market. There is a question about whether there is more strength and whether what we've seen in the banking sector is more of the normalcy, as you point out, rather than a sign of some sort of massive fissure. If it is a sign of strength, what does that do in terms of the stickiness of inflation as well as growth, just like what we saw over in England?
Yeah, well, I think you had mentioned earlier discussion on sales from places like Prada, luxury goods. The U.S. economy still continues to be driven by a consumer, which whether they're spending more than they can afford, it's irrelevant. They're still spending more, and the labor market is not yet rolling over. So there's still strength to the consumer side. There's still strength to the labor market, and in particular in the retail space and in the luxury space and the leisure space. So there's still strength to come in the U.S. economy, and there's still likely to be sticky inflation. What that means is that even if the Fed pauses here, they're not likely to cut as soon as the market is pricing in. The market is pricing in rate cuts for, we'll say, July to August. That seems too early, given how sticky inflation is and how strong the labor market continues to be. We do think the labor market's going to roll over, but we think inflation is going to remain sticky, which means that there's going to be more stress on banks because the Fed funds rate is going to remain at this 5% to 5.25% longer, and you're going to continue to drag on credit formation and stress on banks because net interest margins are going to remain negative for longer.
How do you play this? Because it's really against consensus, at least as it's being played out in market pricing.
Well, that's a tough question because right now you look at equity valuations, they don't reflect a recession risk, and they also don't reflect the fact that there's credit tightening to come later on. Same thing for corporate credit markets. Spreads are a little bit too tight at these levels. So I think you play this by being very cautious. You continue to hold cash at elevated or above average levels, and you wait for something to break to the downside.
Two-part question. We got to be quick because of the time. Where's Trennert on the equity market? Is he called a bottom of the bear market in October, or does he have a more cautious view?
More cautious. We're expecting equity valuations to dip lower again.
So you had a 10-year yield, 4.20%. The 10-year yield is cratered down. What are the ramifications to you if the 10-year breaks down to a new lower yield below 3.30%?
Well, so our forecast is about 3.2 for a bottom this cycle. We could easily on intraday get down close to 3. If we get down 2 or below 3, it tells us that something is breaking on the credit side that's bigger than a regional bank. That would be my takeaway from that.
Hugely valuable. Tom, thank you so much. Tom Storis is with us with Strategas, a Baird company, and really, I love it. It's like with Michael Darda at Roth MKM. We can dovetail in the equity analysis because he's got Trennert screaming at him 24/7 about, buy stocks, own blue chips and all that.
In my very unbiased opinion, I think that people who study the debt markets right now are at the epicenter of all the action, because whether it's
when have I not heard this?
It's the credit of banks or whether it's the credit of companies and how they're doing at a pivotal moment for the economy. It's the income statements, as you've said. It's the cash flows that you're getting in now and staying cautious for what you expect to happen later because of equations that just don't match up if you're basically making net interest margins. Net negative interest margins in some of these banks.
I can assure you, from enjoying losses within the equity market, that Bramo, you're correct. And the only way you learn this as an equity wise ass is to lose money one time or 2 times or 3 times.
In fairness.
So you learn follow the bond market.
Well, in fairness, the bond market's lost plenty of money too over the past couple of years. So nobody's really had too much of an edge at a time of a lot of really unusual distortions and debt ceiling.
We do equities, bonds, currencies, commodities. That's what keeps us going here. Right now, futures at -3. The 2-year yield under 3.87%. Important. James Dimon, Francine Lacroix coming up. Brian Weezer on Disney. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Former President Donald Trump says the U.S. is spending money like drunken sailors. At a CNN town hall in New Hampshire, he urged Republicans to push for spending cuts or go into a default. He said he doesn't believe a default will happen because Democrats will cave under pressure. Polls showed Trump as a frontrunner for the GOP's 2024 nomination. The Biden administration is cracking down on pollution from the U.S. electric sector. Proposed requirements released today would force coal plants and the largest gas-fired units to stifle nearly all their carbon dioxide emissions. Still, the plan would spare most natural gas plants, and utilities would have more than a decade to comply with the limits. Consumer expectations for Eurozone inflation rose significantly in March. That bolsters a case of the European Central Bank officials who say interest rate increases may need to continue past the summer. Now, in its monthly survey, the ECB says inflation expectations for the next 12 months rose from 4.6% to 5%. In Pakistan, the rupee has fallen to an all-time low in wake of violent protests following the arrest of former Prime Minister Imran Khan. The country's Supreme Court is hearing Khan's appeal of his arrest. At the same time, a special court has granted investigators 8 days to look into corruption charges filed against Khan. And for the first time in its 240-year history, the Mann Group will have a female chief executive. Robin Grew will take over September 1st as CEO of the world's largest publicly listed hedge fund. Grew is currently Mann Group's president. She's replacing Luke Ellis. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with a plan.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
You've got to look at the amount of money being spent on content by the companies. From Disney's point of view, yes, you got a learning curve. You've got some dynamic short term. You want to go global.
That was Mario Gabelli, Gabelli Funds Chair and CEO yesterday on Bloomberg Surveillance. This morning, Disney shares lower by 5.5% after disappointing read on subscribers. Is that a shock, Tom, that people aren't really signing up as quickly?
Well, I'm briefed on this by Paul Sweeney, who's basically world famous on this, long ago and far away. He was the guy in the planes doing the junkets.
Oh, I know.
You know,
he's told me many times.
We can, you know, can you come out like in February, or they were on some island in the Caribbean where we'll brief you on, that was Paul's life for like umpteen years. But seriously, I get a huge advantage of seeing this coming. And my number one, I just go back to the word profit. You know, I'm like, where's the beef? Where's the profit? And I just don't observe it.
You're not alone, and that's something that all of the streaming services have really struggled with. They're looking at it for subscribers. In the broader markets, we're seeing basically things flat as people wait for some sort of catalyst. Brian Weiser isn't. We just got one in terms of Disney. He is a principal at Madison & Wall, covering all things media for decades. There is a question here about why this is surprising, given that this transition was going to be awkward from cable to streaming, and it's a rocky process amid a lot of economic uncertainty.
Yeah, I don't think it was that surprising. I mean, this was never going to be a better business than the one that it's replacing, right? They had a nearly 40% margin business in the media networks division back in 10 years ago. And you're going to incur more costs for marketing, more costs for streaming, physically delivering content, and then you need way more content to make this whole thing work, and you can't forcibly bundle. This is the right thing to do. It's the right way to make a business that survives for 50 years and beyond. And that's what I said when I was an analyst covering the stock and thinking, oh, this is the best about the fair price right now. And that's kind of what's played out for everyone.
Brian, there's this concern as we try to grow subscriber bases, or as different people, different streaming companies try to expand their user base. Do you continue to raise prices? What do you prioritize, either increasing subscribers or increasing revenues? How is Disney doing on that front, given that they came in with a pretty disappointing projection of just growth?
Well, here's the thing. They can continue to raise prices and still grow subscribers on a year-over-year basis. And I think they'll continue to do so, as other services will when they raise prices. The problem is that money is coming out of traditional pay TV. I published something on my Substack this past week pointing out that there's about $100 billion of spending in the United States, at least, by consumers on pay TV services. now declining in terms of actual spending. That's $100 billion of money that can go into these streaming services still. But it's going to come out of pay TV.
Where is sports in 5 years, Brian? Disney has a huge effect on sports with ESPN, I get it. But where is the Brian Weiser view on sports entertainment in 5 years?
Yeah, it'll still be super important. I mean, but Bob Iger at least was wise enough to point out that there is an inevitability to ESPN in particular eventually having its flagship service as a streaming service. The reality is that not everyone needs to watch everything that's on ESPN or on traditional TV for sports. So it may end up being a little bit more niche-y, maybe not as ubiquitous as it has been historically in the United States.
I look at Disney and I look at a creative guy as well. Is there a lot of cost cutting to do? Is Disney, and for that matter, other companies like it, is there a lot of fat there to cut, or are they bare bones right now?
You know, they talk certainly about containing their increases in spending on content, and it's hard to say what that is. I mean, certainly there's a great story in the journal about what's happening for Paramount on content spending on Yellowstone and other related shows, and that's a good example, maybe a bit extreme in terms of spending. But I think in general that the thing is, if you spend more money on programming, you will get more viewers, right? They will continue to grow the platform, the streaming platform, as long as they continue to increase their spending overall on programming. Obviously, they need good editorial choices in terms of making good content.
We used to say content is king, and today we're talking about cost cutting in a lot of these different platforms. If anyone goes anywhere near social media, they'll see a discussion of the writer's strike in Hollywood that's affecting a whole host of different streaming networks. And I wonder how dovetailed these ideas are. This idea that writers want to get paid, that content wants to get rewarded given the years of largesse, and the networks just aren't willing at this time. How much is that going to be a persistent battle based on the dynamic that we've been talking about?
Yeah, I worry about that because I'm not sure how first of all, both sides on the strike might be too optimistic in their expectations for how the industry is going to evolve. Again, I rolled up all spending on video, including theatrical spending, DVDs, whatever left of that, streaming, pay TV, etc. And basically, I calculate about a 1% annual growth rate over the last 15 years, every year, on average. Maybe that's about right going forward. It's all shifting towards the far less profitable business of streaming. So there's less money to divide up, whatever the outcome is.
Brian, there was also discussion, just to finish up here with Disney, about declining revenues on their cable networks from advertisers. How much of this is companies not necessarily having the extra money to advertise? How much of this is just all of the advertising moving to Google, to Facebook or Meta, to all of these other social media platforms?
That's been a big factor for sure. I mean, we're seeing television is probably declining by high single digits at this point. I don't think it'll stay that bad all year long. It'll probably get less bad as the year progresses. The typical advertiser is absolutely shifting their spending. Primarily, I think packaged goods companies are shifting spending into retail media networks, which are just doing fantastically well. TikTok, for now, is at least still doing really well. There's a lot of new places that are seeing a lot of growth. I mean, Uber is an ad platform, Walmart is selling ads, that sort of thing.
Right. Brian, thank you. Brian Weiser from Madison and Wall with an update there on streaming and the lack of profit out there. He's 67 years old, had a cancer scare. I guess he's doing well as chairman and CEO of JP Morgan. I don't think there's ever been enough made about the academics of James Dimon. He's summa cum laude out of Tufts, and critically wandered through Harvard Business School with a guy named Immelt, Steve Burke of Comcast, the great investor Seth Klarman as well, and slid out among that talent is a Baker Scholar at HBS. And I just don't think enough has ever been made about it. Maybe it's his own fault. He downplays it, or he had to put up with Sandy Well years ago. But this is a guy, as chairman and CEO of the bank, and we all hang on his annual letter, which was out a number of weeks ago.
In fairness, it's not as if he hasn't been incredibly successful. He does get compensated just fine. There is this issue, though, of whether he can sort of build some sort of successor, because he really is the face of JP Morgan, seeing it through a whole host of different times that harken back to some of the roll-ups that you're talking about in the banking sector today.
I want to frame out in the annual letter, and like one letter a couple years ago, he could tell he was really upset about people don't understand is just the day-to-day executive grind of hard work, you know, the romance of 18-hour days and living on planes and the rest of it. And this year was much more of a strategic response of this is where banking fits in his words, is an essential part of the American economy. And these are real sensitivities. To me, with Francine, it's the angst out there, really going back to J.P. Morgan in the mansion, I believe it was in 1912, or excuse me, the Panic of 1907, where basically J.P. Morgan wrote the check to save the nation. But this idea that you go through our banking history, and now there's this absolute dominance of J.P. Morgan and Bank of America in terms of size, even against the other ones we follow all the time.
Over the past decade, we've been talking about, or a lot of people have been decrying, big banks as utilities, not having the same kind of profit engines as they used to because they can't take as much risk. And this has been the year when people reward banks for being utilities, for being safe, stable revenue drivers that do withstand some of the pressures that we're not seeing at the likes of PacWest or First Republic or some of the other banks that have seen some serious distress. At what point does that model, that fortress of strength, that fortress of diversification, that fortress of trillions of dollars of deposits create something that people just hunker down as a sort of safe asset rather than something that's going to be more volatile with the economic cycle?
Even with the pullback in J.P. Morgan that you've seen, nothing like what we've seen in other banks. I'm going to give them a gentleman's roundup here. The statistic off the Bloomberg is 12.96% per year over the last 10 years. Can we round that up to 13%, just so Francine can get through the interview?
And how much of this, as they gather deposits from all of the banks that are losing them? I mean, we talked about them gaining
Tom
deposits.
Sotoris was clear this could happen again. It's not over.
And just to repeat the news, PacWest deposits dropping 9.5% in a week, mostly over 2 days after some negative news.
In 15 minutes, a conversation with Mr. Diamond of J.P. Morgan, Francine Lacroix in Paris. Really looking forward to that. In 30 minutes, claims. We continue to look at the labor economy of America. Stay with us. Worldwide, Bloomberg surveillance.
So most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're in an environment where inflation is still pretty sticky, well above what the central banks really want.
The market has given a lot of credence to the Fed in their credibility to bring inflation down.
You better be sure that when you stop, you're not going to look back at regret just a couple months later.
They're still focused on inflation. That has to be number one.
We were not in recession in the first quarter. We're probably not going to be in recession in the second quarter.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
30 minutes away from economic data in the U.S., 12 minutes away from a conversation with the CEO of JP Morgan. It is Thursday. Welcome back. This is Bloomberg Surveillance live on Bloomberg Television and Radio. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John is off. He is probably going to be back tomorrow. That is the rumor. We do get this economic data, and we will get to Jamie Dimon and that interview that Francine Lacroix is doing in about 15 minutes' time. But there is a question with the economic data of where we are and whether we will see that creeping higher of unemployment as inflation stays high.
Let's get sobered up. When did we first hear about recession? It's coming.
Well, we heard about it for about a year.
Like for a year or
exactly.
even longer. United Kingdom, recession's coming. Oops, Citigroup, Giannakis with that great reversal a couple days ago. I think Bank of England read the Citigroup note and they reversed it today.
Well, and the fact that they came out and they actually increased the projections for GDP growth, the most on record from a recession to now expansion for 2 consecutive years, highlights the conundrum that everyone's having. Do you stay negative? Do you stay conservative, whether you're an investor or whether you're a corporate executive like Jamie Dimon? Do you stay conservative amid the uncertainty and the upside surprise to economic growth?
Guest earlier from the United Kingdom saying, look, we just got housing wrong. Housing's been more resilient than the collapse that was looked at. And I'm going to take a note from James Dimon. He put a Wall Street Journal op-ed he wrote into the annual letter that he did. The West needs America's leadership. And I'm going to suggest part of that leadership is this insatiable American exceptionalism. It's changed, it's morphed over the years. There's been some ugly moments. But the bottom line is Dimon is channeling the growthiness of the American message versus some of the more austere messages that are out there.
Yeah, and at a time when U.S. growth is perhaps not quite keeping pace with other areas, and I say Europe and China in particular, where it's outpacing almost more
from
the first time, from a lower base without a doubt. But it's the question here is, where are the opportunities? Are they in the U.S.? Because globally, we have seen more and more move to Europe, move to China, move elsewhere where growth potentially could be increasing at a faster pace.
Where's their technology business? I don't see the academic input that you see coming, frankly, from other places. And frankly, continental Europe's got some real burgeoning technologies, but not like the major tech companies of America.
And I wonder how much of that is just a reluctance to try and fail. In the point that, for example, we saw some headlines about Europe pushing back on artificial intelligence and ChatGPT for concerns, and we see this kind of headline going around. Heading into all of that, you're getting no certainty in markets. And I think that is really notable to me. Right now, in equities, before we get to the yield space, in equities, just nothing, absolutely nothing, basically range bound, 4,147 on the S&P, looking at a 0.1% decline.
You don't quote the Dow?
No, I mean, I've been trained well. I'm going to stay out of that argument. I'm going to basically just tread in the other indexing experiences. 10-year going down just a bit. We are seeing yields lower across the board, which is interesting given the fact, especially after the Bank of England, inflation still coming in high. Even yesterday, people cheering the CPI report, and yet Vincent Reinhart saying one report does not make a trend. It doesn't make sense that you're pricing in rate cuts, and yet here we are.
We have to get to Megan Horniman, but Lisa, I'm sorry, to 4 digits, 3.8578%. We are now 15 full basis points in on the 2-year yield in a long cup of Senka. I mean, it's amazing how we've moved.
Yes, and at the same time, the volatility in the 2-year really is what gets my attention, let alone which direction it's going in, the fact that it whipsaws back and forth. How do you get any stability given some sort of risk appetite without that? Joining us now to discuss as we head into a really important hour, Megan Horniman, Chief Investment Officer at Veriden's Capital Advisors. Megan, as we look for the data in the U.S. in a half an hour time, how much are you expecting it to really represent the strength, the resilience that so many people are rejecting right now as simply a passing phenomenon?
Yeah, I think that there is some inconsistency in what we're seeing from whether it's the labor market showing strength, but then that's the only thing from an economic standpoint in the U.S. that's showing strength. Whether you look at manufacturing or you look at housing, all of these things are suggesting that we're headed towards a downturn. And then you take into account the Federal Reserve tightening cycle and then the tighter lending conditions. These things are going to start to filter into data, not right away, but we think in the rest of this year.
Megan, I want to go to your heritage. Legg Mason in Baltimore, all the great value house action of Legg Mason, and on to Deutsche Bank as a substantial East Coast competitor to JP Morgan. We're going to talk to Jamie Dimon here in about 9 minutes. He's salvaging our banking crisis as it is. Is he going to have to do more from where Verdant sits?
Yeah, unfortunately, I don't think the regional side of the banking crisis is over. I do think that the bigger banks are going to have to step in and do more. What's changed? If you look at over the past couple of weeks since he came in and rescued the last bank, nothing's changed from a regulatory standpoint. Nothing's changed from the Federal Reserve. In fact, the only thing that's changed is that the Federal Reserve has said, hey, we're not going to see rate cuts right away. So the pressure that was on the small and mid-cap banks earlier this year with higher interest rates and taking losses there, that's still is the case, and that's going to be a problem for these banks. So in the absence of knowing anything that's changed, I don't think that unfortunately is over. So I think there's going to be more to come.
You have the advantage of not being Manhattan-based. How does commercial real estate look like for Verdant's Capital? I mean, I know it's off your remit, but what is all the analysis you see that you listen to on CRE?
It's something that we're concerned about. I don't think that it's being talked about enough. Obviously, we're concerned just because of a slowing economy and higher vacancies, but then the double effect on that is that we have higher interest rates, and then you throw on top of that we have this maturity wall. That's where the big concern comes in. So between 23, 24, and 25, these are big years where these commercial real estate loans are going to have to refinance, and they're refinancing at higher rates, as well as in a situation where you have tighter lending conditions.
That's an area of concern, an area of strength that we may get a better sense of in about 20 minutes' time is when we get the PPI, the factory input prices that comes out in the U.S. It's expected to be significantly below CPI, that sort of headline consumer figure, which is being captured as profits at a lot of companies that are actually increasing their profit margins at a time when people expected them to shrink for them to absorb some of the inflation against some pushback by consumers. Is this giving you optimism to go into certain stocks, to go into certain credit?
No, unfortunately, at this time, I think that's probably short-lived. The consumer is weak. We've seen that in some of the recent data, and we've also seen that with the fact that they're relying a lot more on credit card debt. They're not spending the way that they used to. If you looked at even the CPI report yesterday, that showed that airfare is actually starting to come down. So you're starting to see some weakness in that part of part of the economy that consumers were really spending money on. So your leisure and hospitality. There's a lot of cracks surfacing, so I'm not optimistic that businesses can continue to pass on those costs without it further hurting the consumers.
So are you basically in the camp that there is going to be this disinflation that will accompany the weakness that we see as it accelerates throughout the end of the year? Basically, what's been pushing everybody to keep going into bonds?
Yeah, I do think that we are going to be looking at, again, slowing inflation, a slowdown in the economy, most likely a recession. The inflation situation has been improving, and we can't deny that, but there still is a lot of work to go. The biggest inconsistency, and you mentioned that people are going into bonds, the biggest inconsistency that we see is that investors are pricing in rate cuts, and that's not something that we see. The Fed is not there. They don't have the ability to do that with inflation where it is. They can't come in with a stop and go approach, which is what they did in the 70s and 80s, which proved to be not the right thing to do. I think they're going to stay on hold. Interest rates will stay higher for longer. They've made it clear in their last meeting that they will sacrifice economic growth to achieve their goal of bringing inflation down. So I think the bond market's not necessarily pricing that in. Unfortunately, within bonds, I think the best place to be right now is just to park money in cash, have dry powder, take advantage of opportunities because they will arise in the second half of this year.
And then on equity markets, do you deploy that cash here, or do you just wait?
It depends on what we see from an equity standpoint. I think equities are similar to bonds. The equity market, specifically some of the high growth technology names, these are, I think, still too high from a price to earnings multiple. I think they have room to decline and kind of realize the fact that the Fed's not going to come in and save the day. They've been able to do that in the past. They're not able to do it this time around. So I think there's going to be some correction here in U.S. equities.
Megan, thank you so much. Megan Horniman there with Verdant's Capital Advisors this morning. I'm going to go back off J.P. Morgan Research as we wait for Mr. Diamond and just suggest I'm still thunderstruck by what his colleague Michael Ferroli said 8 years ago of a run rate of the American economy sub 2%. And I remember at the time it was groundbreaking when he and Bruce Kasman came out with that research report. And the whole thrust of James Diamond's annual letter is a U.S. growth strategy. That's the entire, the theme, if you will, across it. And it comes back to Ferroli being at like a 1.85%, whatever, run rate for the American economy, and his boss saying that's just not acceptable.
Well, and at a time when a lot of companies have been betting on the United States, and that's paid off. I mean, think about Warren Buffett in that meeting that we just saw over there. There is going to be a real question, though, about what his broader strategy is, in particular expanding into places like China or, say, Europe at a time when there is more growth there, and that has been what's been leading a lot of the upside surprises.
What do you think of what Megan said, cash here? I mean, the gloom, not the gloom. It's so strange. I mean, futures 41.49 off fractionally, and yet we're getting research studies that say there's a fair amount of gloom out there, and you hear that with Megan in cash.
Well, and cash yields something, right? I mean, if you're getting 4 or 5% on cash, it's an asset class unto itself. People are expecting this to break in a negative way for the economy. We're at a place of inflection, really, where we've seen the growth, and now do we see the inflation go down with the accompaniment of growth also coming down?
18 minutes to economic data. Before that, Francine Lacroix in conversation with Jamie Dimon of J.P. Morgan, their chairman, their chief executive officer. Futures at -1, the VIX 17.24. Stay with us on radio, on television, Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Bank of England has raised its benchmark lending rate to the highest level since 2008, and it says that more increases may be needed if inflation persists. The central bank lifted its key rate a quarter point to 4.5%. Officials also delivered the biggest upgrade to growth projections since 1997, erasing a recession they had previously forecast. Donald Trump is urging Republican lawmakers to either get President Biden to agree to spending cuts or push the U.S. into its first ever default. The former president spoke in a town hall event with CNN in New Hampshire. He holds a tight grip on the Republican Party, and polls show him as a frontrunner for the party's presidential nomination. For a third day, Israel and Palestinian militants in the Gaza Strip exchanged fire. Islamic Jihad squads launched more than 500 rockets toward Israel. Meanwhile, Israeli aircraft killed the group's chief rocket maker in Gaza. Efforts to reach a ceasefire have not worked. Ukraine needs more time to launch its long-awaited counteroffensive against Russian forces, and that's according to President Volodymyr Zelensky. He told the BBC the army is still awaiting some promised aid from allies, such as armored vehicles. Shares of Disney are lower in pre-market trading. The world's largest entertainment company posted a drop in subscribers to its streaming service, Disney+. And it also predicted a bigger loss in that business in this quarter. And Disney says the loss from streaming will increase by $100 million because of shifting marketing costs. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Default is frankly unthinkable. America should never default. It would be tremendously economically and financially damaging.
The former chair of the Federal Reserve System, the Secretary of Treasury of the United States, Janet Yellen, in Tokyo, in Japan at the G7 meetings. Anne-Marie Horton in conversation with the Secretary of Treasury tomorrow, widely anticipated after a set of economic data. And we do get economic data here in 15 minutes that could change the course of the view on her labor economy as well. Lisa Abramowitz and Tom Keene right now. And what we'd like to do is go to Paris. And it is a Paris of J.P. Morgan that is important. In World War I, I'm going to get the pronunciation wrong, and Francine Lacroix is going to correct me. It is 14 Place Vendôme, and it was the commitment of the J.P. Morgan Bank to France in the heat of World War I. She is joined in Paris with James Dimon, our Francine Lacroix. How was my pronunciation, Francine?
Tom, full marks for French pronunciation. You're almost French. I'm so excited for you. I am delighted to be joined by Jamie Dimon, J.P. Morgan Chairman and Chief Executive Officer. Thank you for joining us, as always. Debt ceiling or banking turmoil? What are you most worried about?
Happy to be here. Well, I think the debt ceiling is potentially catastrophic.
Yeah.
So that's a whole different issue. Hopefully it won't happen. You know, the banking crisis, I still believe, will kind of sort its way through. And it's not anything like 08 or 09. Only a couple of people are offsides with all these various things, which you knew about. So hopefully, you know, it's getting near the tail end of that.
But if you're Janet Yellen right now, what would you do differently?
I don't know. I think we need to finish the bank crisis. I think we've had uncertain policy on mergers, this First Horizon deal. I think we have to assume there'll be a little bit more. So, you know, whatever the FDIC, the OCC, the Federal Reserve, you know, whatever they need to do to make it better, they should do. Be thoughtful, be very forward-looking, you know, not be surprised constantly, because some of these things have been known about for quite a while. And so we've handled three: SVB, Signature, First Republic, and so.
Yeah. So,
but I think it's very important. The regional banks, who I've been speaking to like every day for the last week, they're quite strong. You know, they're quite worried because of the run on deposits like that. But their financial results are good. Their financial results are going to be good. Okay, next quarter. You know, they're earning money. They got a very good clientele, very diversified, and they're quite strong.
So, Jamie, for like a comprehensive solution. So, if you're asking Janet Yellen to get the job done, what does that look like? That solution?
I'm not asking for a comprehensive solution.
Why not?
Just be prepared for problems. We don't need a comprehensive solution.
What do we need right now? Do we need regulators to look at short sellers of banks?
Yes. You know, look, my folks would tell me that that's not the problem, the short selling ban. If you actually analyze stocks and short sales, doesn't seem that big a deal. I think they may partially be wrong because, as you know, some people are unscrupulous and they use other means to go short. I think that if you look at the detail, the SEC has the enforcement capability to look at what people are doing by name in options, derivatives, short sales. And they should go, if someone's doing anything wrong, people are in collusion, or people going short and then making a tweet, about a bank, they should go after them, and vigorously. And they should be punished to the full extent the law allows it. So I think it's possible it's taking place. We have no evidence of it, but my experience in life has been don't assume too much.
Do you think that they're looking into it?
I hope so. I don't know.
When you look at some of the position of J.P. Morgan, of course, you didn't really buy any long-dated bonds. And at the time, a lot of people said, look, stop hoarding cash. Do you think regulators and investors had pushed some of these banks to take unwarranted risk?
Yes, I do. But let's be clear. The people to blame are the bank CEOs and the bank boards and things like that. Having said that, I think there's been a humility on the part of regulators that the Federal Reserve itself never forecast interest rates going up. Not one Fed governor forecast it. And whether you forecast it or not, you should be stress testing people for it. Their stress tests always had low rates. We always knew about uninsured deposits. And there were huge incentives that banks to put securities in held to maturity, lower capital requirements. Huge incentives to own treasuries, lower capital requirements, and they counted for liquidity. And I'm hoping all that gets looked at, and they should look at it and say, yeah, okay, we were a little bit part of the problem, as opposed to just pointing fingers.
So this is what, not a regulation problem, it's a supervision problem.
Yeah, it's a little bit of both. They become very related. I mean, supervisors look at, are you doing the right thing by regulations? And like even the stress test, I've always thought that, when you have one stress test, and you have a company completely focused on that for 3 months, does it lull people to a false sense of security that all these other things aren't going to happen? And all these other things in history always happen. And so, I think it was a little bit of a mistake to have one stress test. I'm not asking them to do many at this level of detail, but, our stress test is 200,000 pages long. Do you think that last 100,000 pages added value? And my view is it did not.
Do you think things will change because of this? Is this like a catalyst?
I think it's going to get worse for banks. I think that people.
What do you mean by worse?
It's just more regulations and more rules and more requirements. I hope they do it very thoughtfully because, we love the community banks, the regional banks. We're the biggest bank to those folks. But, if you overdo certain rules, requirements, regulations, some of these community banks tell me they have, more compliance people than loan officers. And so at one point you make it harder for them to do business. There are already hundreds of rules in place. And in a lot of ways, it's the mix of the rules. If you're going to change liquidity, maybe not capital. If you're going to change capital, maybe not liquidity. If you're going to add TLAC, then maybe you should do something with deposit insurance. They should sit down and have a very thoughtful conversation about what those things are and what we want the outcome to be. And if you look at the present outcome, a lot of things are leaving banks. And they should. If that's what they want, so be it. But that should be done with the forethought. That should not be done because you're just putting rules and regulations in place and you don't know the consequences. The mortgage business, for example, is not largely, 80% out of banks today. And just be careful about what you wish for.
So you bought First Republic. You've had, I imagine, now a good look at what's inside it. What did you find out?
Yeah, no, we had a good look before we bought it.
Okay, that's reassuring, but anything that you found out
We had 800 people working around the clock for a long time to look at something like that. And in reality, look, they did some things really well. Like if you talk to their customers, I'm getting calls and emails and great culture, great customers and things like that. Right. Their credit is kind of pristine. That's good. So, of course, we marked all the market and we're all in very good shape. We've hedged all the interest rate exposure together. We've got thousands of people now going out, learning about what their best is. We want the best of both. We're not the kind of company that comes in our way or the highway. And so there's no surprise there. It had to make sense for shareholders, but this notion that it was an unbelievable thing, no, it was a nice thing for shareholders. That's I have to do that. But we also really did it to assimilate the banking in a way that's very safe for the system, and it didn't cost uninsured depositors, didn't cost the FDIC. It cost the FDIC as little as possible. But I also want to point out, I'd be fine if they want to change the rules a little bit to make it easier for a regional bank to buy a big bank. And the other thing about big banks, which again is, I know, but the thing about big banks, we need healthy big banks. We have the best banking system in the world, and you want that.
You're very big.
Yeah, but we're not. Banks are becoming smaller and smaller as a part of the global system. So when they look at banks, they say, oh, it's big. But when you look at the banking system to the system, mortgages have left, a lot of private credits left, certain trading functions have left. A lot of things are going to leave. You have Apple, you have the neobanks, you better be a little more thoughtful about when you say we mean banking per se. Okay. And so.
But the U.S., the Americans should not fear too much finance consolidation in your hands.
No, because most of our size accrues to our clients. So if you look at we do small banks can't do. We do like banking large corporations in 50 countries around the world to move $10 trillion a day. It's hard. So these are big complex things. We're not big and complex we want to be. Yeah. We're big and complex because the people we serve are big and complex. We bank countries, the World Bank. We do a lot of things. And yes, we also bank consumers in the United States. But I want the community banks to thrive. I mean, like I said, we want to do everything we can to help them. We didn't want this to happen. We didn't cause it to happen. The second it happened, we knew it was bad for all banks.
Are you too big to fail?
I don't know what that word means anymore. I mean, we're not going to fail, and I don't know what that means. But we certainly didn't mean it to be an advantage. We've asked all our people, when this crisis happened. I don't want anyone soliciting any client or any banker from any bank that's regional bank or community bank, et cetera. So
is there anything else that you'd be buying? I mean, some of the smaller banks fall, fund. That's it.
No, I mean, we're gonna have a lot of blowback on having bought this one, but it was the right thing to do, But we'll get the blowback. But again, my job is this. People at this thing, they always look at like the financial deal. Forget the financial deal. 800 people working around the clock. 10,000 people deployed now to consolidate systems, risk, fraud, credit, payments, branches, real estate, vendors, technology. It's a lot of work, and it distracts us from those other things. And so, like I said, we did it. It was marginally beneficial for shareholders. Yeah. It was good for the system, but we have to be prepared for the other side of that mountain.
How worried are you about the debt ceiling? So Donald Trump yesterday in a town hall with CNN, A, did not seem too worried, and 2, actually told Republicans to stick to their guns.
Well, one more thing he doesn't know very much about. Let me put it in 2 categories. One is actual default. That is potentially catastrophic, and you can go through a million ways, but anyone knows that's potentially catastrophic. And I don't think it's going to happen because it gets catastrophic. And the closer you get to it, you will have panic. And so the closer you get, you have markets get volatile. Maybe the stock market go down. The treasury markets will have their own problems. It's amazing you already have certain T-bills trading 3% and right next to them 5%. This is not good. And people should remember the American financial system is the foundation to the global economic system. And so, and the closer we get, more panic. We might get downgraded. The last time we were downgraded, we had like 65 or 70% debt to GDP. Now it's 105. Now our deficits are 2 or 3 times that we had back then. So, we better be very careful. And I wish we didn't get there at all. I'm respectful of both sides who, one side wants to use it to make up for it. We got jammed down their throats, and I would love to get rid of the debt ceiling thing, but please negotiate a deal.
Do you think that it'll be, at the end of the day, the markets that will spur a deal? That we have to get to the point where there's panic?
It's a really bad idea, because panic becomes something that is not good, and it could affect other markets around the world. But yes, at the end of the day, if it gets to that panic point, people have to react. And we've seen that before. And the other thing about markets is always remember, panic is the one thing that scares people. Like they take irrational decisions. I remember even in 08, people were selling certain securities at 40% of what they would be worth if we had a Great Depression. But they were like, I want out, I want cash, I'm not betting my family's money on this or my company's money. People will panic, and again, we got to be very careful about getting close to a situation that causes that.
Did you get a call from Janet Yellen about this?
I'm not going to talk about personal calls I'm getting. We've all spoken about debt ceiling. I mean, everyone, that's everyone. There's no...
But for big banks, are you ready? Actually, how do you prepare for a possible
We have
default?
a group of people who are very smart, who are looking at, again, it's very unfortunate, it's time-consuming, hopefully it won't happen, but it affects contracts, collateral, clearinghouses, clients. It affects clients differently around the world. You have to then anticipate what people are going to do, which is very different than the legality of it. And and the closer we get, the more those kind of that war room will start. Now it's taking place once a week, but my guess is sometime in, call it May 21st, it'll be every day, and then it'll be 3 times a day. And then it'll be much more conversation with clients about what they need to do to help to get them through it and things like that. It's very unfortunate. It should never happen this way.
Fortress Diamond is always about the balance sheet. Should there be a special commission looking at debt in the U.S. that you should run?
Oh, God, no.
Why not?
I don't want to.
On China, they went after tech. They're looking now at finance. What kind of message does it tell companies that want to do business there?
Well, I think when you say they're looking at finance, it's been very limited. They've been very much more careful about touching the financial system or outsiders. But look, this is a serious subject. And anything that relates to national security, I'm a patriot first, and I'm going to salute my government. So put that aside. What the government should do and wants to do, and is now saying they are going to do, is have conversations. They're going to be tough, but they should be thoughtful. Certain things are really national security. Certain things are not. And we shouldn't confuse the two. America and China have a lot of common interests: climate, nuclear proliferation, anti-terrorism, global stability. And we have differences. We're capitalists; they're not. And it's okay. We could sort that out. But we need to keep the Western alliances together, not just around war and Ukraine, but around strategic economic relationships, including trade. We can't take trade off the table every time we talk to, Europe or Asia and stuff like that. So I would go back to the TPP. I would surround the world. I'd want to keep the world safe for democracy, and I'd want to have open markets, particularly with Europe. And when I was here last time was when we passed the IRA Act. A lot of great things in that act, but there are things I don't like too much social engineering inside of it, but also it pissed off all of our allies.
But Jamie, on the China side, so if they start doing more noise on finance, does that hurt Chinese growth?
Probably. I think you've already seen, it's not trade, but you've seen investment going both ways coming down. And that's okay in the short run, but in the long run, we should say and the government's got to decide. This is not going to be business companies decide, nor should they. So when Congress criticizes business sometimes, there may be truth to that, they have to decide. What is okay, what's not okay, what do they want, what's security, and that's around trade, that's around investment, and that's around sharing IP.
Okay, I give you £1 million, or maybe you take it, your own £1 million. Where do you invest right now?
Morgan, I wouldn't buy sovereign debt anywhere.
Why?
I think there's too much. The amount of fiscal stimulus took place and still surging through the system, the amount of QE, these were extraordinary numbers, and not just in the U.S., but in Europe and in other parts of the world. And when I say extraordinary, I mean extraordinary. And therefore, I think there's a chance you have more inflation than people think. So while the Fed controls short rates, they don't completely control longer rates. And that you could see longer rates ticking up because of higher inflation. And even if there's a mild recession, they continue to tick up. A lot of us experienced that in the 70s and 80s, and I would be a little worried about that. So rates are kind of low, spreads are still kind of low.
Okay, so you're not putting them in sovereign. Where are you putting that $1 million?
Central banks.
For stability? If you look at fragmentation, I mean, the world seems a little bit odd. Like equities are doing one thing, but we keep on being told there's a recession. Why is there this massive idiosyncrasy?
Okay, that's the contradiction. There's still consumers in America, unemployment is 3.5%, home prices have gone up for 10 or 15 years, stock prices have gone up for 10 or 15 years, they have $1 trillion more in their checking accounts, they're spending that money. You see it in travel, you see it in restaurants, you see it you've been around here, you see it in hotels, you see it, that's all good, but the excess money is being spent down. So the bite of that is going to happen later this year, early next year, and the bite of QT hasn't happened yet. So if you have higher inflation, so I think it's a reasonable thing to say those things are coming to fruition maybe sometime in the end of the year. Yeah. We don't know the effect of that. If there's I would take a mild recession happily right now. I am far more concerned about geopolitics, Ukraine, trade, Russia, our relations with China, and et cetera. And I always have to remind all of our public, America has a 75,000 per person GDP. Yeah. China's is 15. We have all the food, water, and energy we want. They import 10 million barrels of oil a day. I mean, they're not a 10-foot giant and us a 4-foot pygmy. We have to manage ourselves better. I think we can grow more, be more thoughtful.
But in the market, so, a lot of people say it's commercial real estate. I mean, we talk about nothing else. Everybody knows that could break. Is there something that we're not seeing that could break?
I think it's amazing when you talk about markets that sometimes it's, and the press sometimes, like a bunch of birds flocking to one thing with endless comments about it. Yes, that's an issue. So, if you look at office real estate, in B and C real estate will probably have a problem. Chicago, New York, Portland, Seattle, but probably not Nashville, Tampa, Orlando, Miami, et cetera. So you got to be a little more thoughtful about it. And I think if I remember, banks have $600 billion of office commercial real estate. They had a cushion, so even if it dropped in value, they still have equity in it. Maybe some of that will go bad, particularly if there's a recession. They're going to be okay. It may take a few banks down. That's normal stuff. That isn't abnormal. What is abnormal is the war, trade, the future of democracy. That is abnormal. I'm much more concerned about that than
how the markets trade that. Right. If there's a big geopolitics, there's how do the markets do that? Okay.
Look, if I was we're cautious. Yeah. I remind people, businesses aren't there to trade us sometimes. They're there to serve our clients, okay? And so we're going to serve our clients no matter what happens.
Yeah. James, very quickly, final question. How are you feeling about the Epstein deposition this month?
I am so sad that we had any relation with that man whatsoever. We had top lawyers evaluating this from the SEC enforcement, the DOJ. You know, and obviously, had we known then, we know today, we would have done things differently. But it's very unfortunate, and I have deep respect for these women. That doesn't mean we're liable for the action of an individual, but I do have deep respect for them. My heart goes out to them, and.
Jamie Dimon, thank you so much for your time today.
Thank you.
Back to you.
Francine Lacroix, thank you so much. A conversation with the chairman and the chief executive officer of JP Morgan. I would really underscore off of his annual letter his focus on geopolitics. And as he says in his letter, in his Wall Street Journal essay of a number of months ago, he is very concerned of the Western alliances, including France. Lacroix from Paris this morning. In the meantime, we have had a reaffirmation of lower interest rates in the United States. A two-year yield with a 3.82 handle moments ago. That was over 4% 2 cups of Sanka ago. Michael McKee and I grew up drinking Sanka. He's here as the international economics and Sanka correspondent for Bloomberg. And 2 days in a row off inflation and off of claims and PPI, the markets move.
Well, you want some good news on inflation, you're going to get it in the PPI. It doesn't have a direct relationship, as we've said very often, to CPI, but PPI comes in basically a little lower than anticipated, higher than last month, but on a year-over-year basis, it's down. Final demand up 0.2% compared with a 0.4 drop the prior month. The core up 0.2 compared with flat reading. That's a revision upward for the month, but on a year-over-year basis, 2.3% for headline and 3.2% for core. Those are both down from 2.7 and 3.4. So definitely progress on the factory gate prices. Jobless claims also feeding into that. Maybe we're done for the Fed because the labor market's getting looser theory. 264,000 from an unrevised 242. So a jump of
that's a jump. Jump's the right word, right?
24,000 on the month. Continuing claims 1,813,000. That's a gain of about 12,000. So it does look like the labor market is starting to respond, at least in the claims area, unless there's something unusual to it. And we're seeing lower inflation.
You nailed yesterday in real time, which is what you do, Mike, the vector of service sector inflation. I featured what you did yesterday, this morning, going from 7.3, I believe, to 7.1 to 6.x, whatever. The vectors are in place for disinflation, right?
Well, yes, you can say we're seeing disinflation. It's just a slow process. The number you're talking about, obviously, is Jay Powell's indicator of core services, ex-housing, because we're waiting for housing to start dropping. It did not in yesterday's CPI, but once that does, as Bill Dudley told us yesterday, we should see inflation, at least in the CPI headline number, start to go down significantly.
I'm not going to mince words. Markets moving here. The 10-year yield 3.36% and the 2-year yield to 4 digits 3.8266%. The only word Vince Scully helps out here. Remarkable to see that this morning. This is well timed. Sometimes, we think, let's get John Riding on. He's with Breen Capital. He has worked tours of duty with the Federal Reserve System and also with the Bank of England. And then you just plain get lucky. Joining us now, John Riding on his Bank of England. Citigroup comes out. They say, we got it wrong. We were calling recession doom and gloom in your United Kingdom. It looks more resilient. Do you buy the resilience?
The UK is a small open economy, and what happens in the rest of the world is going to be very important for the UK. I'm still a bit skeptical on that. I think the full impact of adjustments post-Brexit, that's still out there for the UK. But what I'm more skeptical about is the decline in inflation, where the inflation rate in the UK is currently 10.1%. And within a couple of years, they're down to basically 1%. And I don't see how you get that kind of inflation drop with an interest rate of 4.5%. I'd be very surprised if in the US we're above 5%. We've got to, and the inflation problem is not as bad as in the UK. That there's more rate hikes than the market has priced in.
You are the single best person I know in the world qualified for this delicate question. I began this morning with Jeffrey Yu on this. I was thunderstruck by what the PhD from Stanford, Hugh Pill, said this morning about begging United Kingdom people to spend less money. It reminded me back to the 30s, Clement Attlee, the elites telling United Kingdom, please don't spend money. I'm absolutely, the non-American-like language that we hear out of the United Kingdom elites and authorities now is absolutely exceptional.
Well, I think it was I agree, but I think it was very interesting that Doncom, I think it was brought up just the other day about the UK. There's too many Keynesians. There's too much groupthink. Inflation is a product, in the end, of too much money, chasing too few goods and services. And it's not about, in my opinion, how much consumers spend. That's part of the transmission mechanism. Rate hikes soften the housing market. They ultimately soften consumer spending. But if the Bank of England had put more thought in the first place to not, same is true with the Federal Reserve, if they put more thought in the first place to not letting the inflation genie out of the bottle, he wouldn't be out there begging consumers not to spend. I mean, or saying people have got to get used to being worse off.
Well, just because of time, John, I want to bring this over, and we're talking here, folks, about a middle 20th century theory, a theology, if you will, in the United Kingdom. Do you sense a Keynesian tilt at the federal system of the United States? Do they have illusions of a demand side ordering of people to spend less money here, or are we to a new regime in America?
Well, that's exactly what the Fed's trying to do, but what has prevented monetary policy from biting on the economy was all of the fiscal injections, the income support provided during the pandemic, which ended up in people's bank accounts. So at the peak, people had $2.5 trillion more in aggregate in their bank accounts than they would have had there not been a pandemic. So it's very hard to slow the economy down on the consumer side. It's much easier on the housing side.
Given the stimulus, Olivia Bonchard calls it the Biden stimulus. Do you and Conrad de Quadros suggest we've run out the stimulus and now we're back to some form of normal American economy?
I don't think we've run out all the stimulus. It's probably close to $1 trillion still of excess savings, but we have seen an adjustment in the savings rate, which is still lower than one would expect. Given where inflation is, given where interest rates are, people are still spending more than you would expect, given fundamentals, because of these excess savings they have.
I got 30 seconds. Do you have a recession call?
I think that in both the UK and the US is inevitable, but not imminent. The inversion of the 3-month T-bill to the 10-year yield has invariably correctly predicted a recession a year or so out. Now, we may have a rolling recession. The housing market's in recession. The manufacturing sector's in recession. The service sector's still going, relatively speaking, strongly. So maybe it's a rolling recession, but I think it's inevitable.
John Riney, thank you. Just brilliant there with his experience with the Bank of England, the Federal Reserve System. He is with Breen at Capital. Red and green on the screen. NASDAQ with a little bit of lift. SPX down 2 points. The VIX 17.27. 3.83%. A stunning yield on the 2-year note. Stay with us. Bloomberg surveillance.
Keeping you up to date with the news from around the world. With the first word, I'm Lisa Mateo. Former President Donald Trump says the U.S. is spending money like drunken sailors. At a CNN town hall in New Hampshire, he urged Republicans to push for spending cuts or go into a default. He said he doesn't believe a default will happen because Democrats will cave under pressure. Polls show Trump as a frontrunner for the GOP's 2024 nomination. The Biden administration is cracking down on pollution from the U.S. electric sector. Proposed requirements released today would force coal plants and the largest gas-fired units to stifle nearly all their carbon dioxide emissions. Still, the plan would spare most natural gas plants, and utilities would have more than a decade to comply with the limits. In Pakistan, the rupee has fallen to an all-time low in wake of violent protests following the arrest of former Prime Minister Imran Khan. The country's Supreme Court is hearing Khan's appeal of his arrest. At the same time, a special court has granted investigators 8 days to look into corruption charges filed against Khan. Adidas is leaning toward the sale of its Yeezy products for charity. That's according to CEO Bjorn Gulden. He says that several charitable groups have advised the company not to burn the gear. Adidas broke off its business ties with the hip-hop artist once known as Kanye West after he made anti-Semitic remarks. The Yeezy inventory has a retail value of $1.3 billion. And for the first time in its 240-year history, the Man Group will have a female chief executive. Robin Grew will take over September 1st as CEO of the world's largest publicly listed hedge fund. Grew is currently Man's president. She's replacing Luke Ellis. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Is potentially catastrophic.
Yeah.
So that's a whole different issue. Hopefully it won't happen. You know, the banking crisis, I still believe, will kind of sort its way through, and it's not anything like 08 or 09. Only a couple of people offsides with all these various things, which you knew about. So hopefully, you know, it's getting near the tail end of that.
Jamie Dimon in Paris with Francine Lacroix, a spirited conversation. At the end of it, really turning around to the geopolitics that Mr. Dimon has been focused on in our Western alliance, as he writes about in his annual letter. A little bit of talk as well on the banking crisis that is unfolding in real time. There was a FDIC headline, I think in the last 45 minutes, about special assessments. I have no idea what a special assessment is, but there's a special assessment announcement potentially coming from the FDIC. Today. Red and green on the screen. I'm watching the 2-year yield, which is the only reason we have Ira Jersey on 3.83%. Good morning on Bloomberg Radio Television. This is a joy. Ira Jersey with his chief U.S. interest rate strategist, Bloomberg Intelligence. He and his team really writing on the short term and also focused on the short term. Michael McKee off of the economic data today. And Ira, let me start with you. We've had abandoned a collared yield structure, I'm going to say back to the middle of March. What happens to your world if the 2-year yield, say, falls below 3.80%? What does it signal if the yield breaks down? It hasn't yet.
Yeah, so if the yield breaks down, it's just signaling that the Federal Reserve is going to be easier. It's certainly that the market is thinking that we're going to have a much slower economy. I mean, in my view, the market is probably not really going to start to see a big trend lower in short-term yields, probably for another 3 to 4 months. But it is coming. It's on the horizon, and I think some people are starting to get set up for that. So people were short two-year Treasuries and long 10-year Treasuries. That is probably going to start to unwind, and you've already seen that a little bit, but I think that accelerates as the year goes on.
Is the 3-month space, is guys like you say, is the 3-month space so distorted by the debt discussion that you can't use it for Fed analysis?
Yeah, that's exactly right. So when you look at T-bills and the fact that money market mutual funds are avoiding certain maturities, especially the 1 month, the 3 month range, like you mentioned, Tom, you can't really use T-bills for analysis of what the market's thinking about the Fed. But we do use other instruments. So for example, the overnight index swap rate, which is based on which settles to the federal funds effective rate every day. Those are the instruments that we have to use right now to assess, the path of policy over the summer.
With us in New Jersey is our Michael McKee. This is funny, Mike, because usually you got 42 pages to go through and you have these brilliant insights 40 minutes later, nuggets that we couldn't do Mike, after 42 seconds, what's going on? But actually today with the PPI, it's a little simpler than all that data. What is beneath the headlines on PPI?
Basically just that in general, producer prices are going down as supply chains normalize, and they're heavily affected also by energy prices, which during the month they'll go back down again, but electricity prices have fallen, natural gas prices have fallen, so that helps with that. The one interesting thing is service prices in the PPI rose. You know why? It's these guys' fault, because banks and broker dealers were charging more because of the volatility in the markets.
So they raise their price and that gets into PPI. Fascinating.
Yeah.
I did not
it does.
know that. Do you have an observation for Ira Jersey?
Well, I wanted to follow up on something that Jamie Dimon said. You guys were just talking about the yield, debt ceiling, and Jamie told Francine that at some point we're going to have a panic. And that's going to be what will put the pressure on Washington to get something done. Do you agree with that view, Ira? And if so, when and in what assets?
Yeah, so Mike, it's interesting you say that, because I've been getting this question a lot, and like even people on Capitol Hill calling and saying, where can I look to see where the panic is based on the debt ceiling? Everyone seems to be panicked, but the market's not showing it. Well, firstly, T-bills. What has tended to happen in the past, and what will probably happen this time, is we'll go another couple of weeks, and when we're about a week before we're actually going to default, the markets will just crumble, right? So you wind up having maybe 10-year Treasury yields actually rally, and you see lower yields in the long end of the Treasury curve because the stock market's down 5%, 10%, like something like that. So it'll be almost every asset will be affected, but probably not right up until we're against the wall, and that might be the impetus for Congress to actually act. I've said this before to both of you. This is the dumbest debate we have. It shouldn't be something we can't default on our debt. If the United States does that, there's a lot of potential knock-on effects in the longer term that you can't take back. You can't promise, hey, we'll never do this again once you've done it. So Congress really does have to, I think, address this somehow. And we need to, have a budget fight when you're debating the budget. Don't have a budget fight when you're debating whether or not to pay the bills.
Another question along those same lines, Mark Cudmore writing today for Bloomberg that the bond market is back, and he says even leaving aside the debt limit, you're going to have a bond market that is going to be pushing the other financial assets and the politicians around because short-term rate cycle is turning.
Yeah, well, the market certainly thinks that the Federal Reserve is going to be cutting interest rates starting later this year. And, Mike, when you talk to Anna Wong, who's our chief economist for the U.S. for Bloomberg Economics, and I concur with this, I think the Federal Reserve is going to be more reluctant to cut interest rates. But when you look at the distribution of really what the market is pricing, we're not pricing for 2 or 3 cuts this year. We're really pricing for no cuts or 150 basis points of cuts. So basically, the market thinks there's some small risk that there's a crisis later this year that's going to cause the Federal Reserve to cut interest rates massively. And if not, the market's going to do nothing. And we look at that using options on some of the short-term instruments that I was just talking about with Tom.
I look at this, Mike McKee, and we get to June 14, July 26. When do we get a DOTS redo, and what do you expect when we dot adjust?
June is the next forecast, and I think it's going to be less about the dots because I don't think they're going to want to move them unless we get some surprising inflation news ahead of that June meeting. But it will be in the forecast because their forecast for unemployment right now makes no sense. They think we'll get to 4.5% by the end of the year. And given the strength of the economy and the fact that we're at 3.4%, you'd suddenly have to see hundreds of thousands of jobs being lost. And it doesn't look like that is going to happen. So it's going to be interesting to see how they reframe the economy and their forecast for it going forward.
I mean, the jobs thing here is just absolutely critical. Let's take it to a non-farm payrolls, which is, I think, the audience on radio and television can wrap their heads around. We're at 200-ish. Claims are coming up, and it's a whole different algorithm. I get that, a whole different reaction function. But the fact is, what number does Mike McKee need to see, 3-month moving average of non-farm payrolls, to get to that employment guess of the Fed? The answer is it's a shockingly low number, isn't it?
Well, if you were just trying to keep the unemployment rate from going up, going down, and just fill in the jobs that are created each month, it's going to be somewhere around 80,000 to 100,000 because the labor force has gotten significantly smaller and the baby boomers are out. And people, remember, everybody during the pandemic went back to school. Well, they're starting to graduate, so they're done. So we need fewer people in the markets, even though some labor market, even though some categories like leisure and hospitality are still desperate for people.
Ira, some data here. 2-year yield 3.8266. What will your team write about to stagger to Friday?
Yeah, so I'm talking about whether or not the Federal Reserve can actually jawbone out some of the cuts that are being priced into the market. Because if the Federal Reserve can convince the market that they're not going to be cutting aggressively later this year or early next year, that's as good as them doing more hikes. And I think when you saw the data this morning and you saw the data yesterday, certainly inflation is better than it had been, but it's still well above the comfort level of the Federal Reserve. So that's what I'm talking about, and that note will be out on Monday.
Ira Jersey, thank you so much. Look for that Bloomberg Intelligence over the weekend and into Monday. Well, Michael McKee, thank you as well on PPI and claims and the ballet forward. I thought John Writing was just brilliant there on this just differential across the Atlantic with Britain and with the United States. We're going to move from a conversation with Mr. Diamond of JP Morgan to a conversation in the way too early morning. McKee won't be up. I won't be up. Anne-Marie Horden will. From Japan, the west coast of Japan, overlooking the sea to Korea and Russia, Janet Yellen, the Treasury Secretary of the United States, tomorrow morning, 3 a.m. New York time, 8:30 in London, in the afternoon, Hong Kong. Stay with us. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Horden.
It's the one area, really, of bipartisanship.
I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement
and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. 30 minutes away from the start of trading, and we can see markets searching for direction amid a confluence of data showing inflation slows, and yet so does growth. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, fresh economic data strengthening the case for a pause. Secretary Yellen doubling down on her default warnings as the regional banks take another leg lower. We begin with the big issue nearing the end of the global rate hiking cycle.
Inflation is the big problem.
All of these central banks have shifted to focusing only on concurrent data.
Inflation, that's what matters.
At some point, they need to make the shift because they're waiting for these lags and it doesn't work.
They're now moving towards a pause.
They could pause here.
I do think we're in pause territory.
It's definitely optimistic to think about a rate cut, not so optimistic to think about a rate pause.
They're seeing some cooling in the data. We think rates are restrictive enough. We want to wait for those long and variable legs.
This has been, in reality, a very slow-moving economic cycle.
Have central banks tightened enough? Have they tightened too much?
It's a fairly nuanced position at the moment.
Pause and let's wait.
I don't know how much of a difference 25 basis points makes at this point.
The devil will be in the details.
Joining us now to discuss is PGIM's Lindsay Rosner and Zach Griffiths of Credit Sites. Lindsay, I want to start with you. You know, honestly, we've been getting all of these data points, and today PPI dropping the most since 2021, but jobless claims rising to the highest level since 2021. Is this accelerating the downturn that so many people have been talking about?
I think the big takeaway is the data points we had prior to today. There was nothing that we could see, I think, in PPI today that would change the story. And in fact, that number was bang on. If we were worried about core goods and inflation, PPI is something we care about. We're not worried about core goods. We've had the information we needed to see to have the Fed pause, to not hike anymore. And our thesis that they'll cut at the end of the year, despite what we just saw in claims, holds.
Zach, is your opinion the same, that basically what we're seeing is a disinflation that gives the Fed some breathing room that really does point to slowing growth, just like so many people said?
No, Lisa, I'd actually take the other side of that. Looking at the CPI data released yesterday, I'm a little bit concerned about the trend in core goods that we thought was very encouraging in Q4. It's really reversed, and you're seeing core services start to come down, but the core goods side of the equation come up. So that's something that we're a little concerned about when it comes to considering how sticky inflation can be with the policy rate where it is in the tight labor market that we have. I think today's PPI data and the jobless claims is encouraging in the softening of the labor market and bringing inflation down at least a little bit. But looking at CPI, we're a bit concerned about that good side of the equation.
Zach, you weren't alone. Richmond Fed President Tom Barkin reacted to just that data, telling the Associated Press, quote, "I'm still open to the notion that demand is settling and inflation will follow in relatively short order, but I wouldn't say I'm convinced yet. Inflation is still stubbornly high." Lindsay, how would you respond to that, given that you are seeing some sort of disinflation, and yet even Fed officials are saying it's just not comforting?
Yeah, look, they're looking for 2%. We don't see 2% yet. So I think that statement isn't incongruent with what we believe. But I think it's clear that inflation is rolling over. PPI is a leader to CPI. PPI peaked in March. CPI peaked in September. This is all working in the right direction. Maybe the speed of travel isn't as great as the most optimistic would want, but it is definitely moving in the right direction. There have been a ton of hikes put into the system. I think we're definitely warranting a place where we pause. And again, towards the end of the year, I think we cut. I mean, what we're seeing with the volatility that continues in regional banks this morning, there are issues in the market. And I don't think we can just be blindly focused at inflation and its stickiness.
We're going to get to the banks in just a minute, but just in general with this trend of disinflation, but also growth slowing, there's a question of what it means for risk assets. UBS's Mark Heffley is saying investors may be getting ahead of themselves, writing, quote, "While inflation is trending in the right direction, we still see potential for disappointment among equity investors on the pace of Fed easing in the remainder of this year." Lindsay, would you be cautious in equities?
I would. As you know, I'm biased. I'm a fixed income person, although I started in convertible bonds, which is a little bit of both. But I think the equity market is missing a lot of what's going on here. I mean, the VIX in high teens just seems to be telling a completely different story than the fixed income market. And I think the fixed income market's got it right. There are definitely some concerns about what this means for corporations going forward. We've seen earnings. They are not as bad, but the number is still negative in terms of earnings quarter over quarter. So that's important to keep in mind. And equities just seems to be completely looking through it.
Zachary, I'm curious your vantage point, especially from the credit side of things, given that a lot of what we're seeing is actually pretty good for credit, that you have a sort of stabilization with respect to inflation, but you still see some growth. How do you push back against some of the pessimism out there in credit land where people are saying, just wait, just wait, just wait? Do you, or do you embrace it and say, yeah, things are going to get ugly?
We don't think things are getting ugly yet, Lisa. And when I think about the current environment, I kind of think carry is king. There's a lot of yield out there. We're not expecting a recession this year. We think the Fed's on pause. And if we can get a little bit of stability from the rate side of things, from a monetary policy perspective, if we can get a little bit of clarity on the regional banks, our view is that the concerns there are overblown. We think things are going to be a pretty solid backdrop for credit. I do agree that the equities seem a little bit buoyant and have been less concerned in aggregate with respect to regional banks, some of the volatility around the debt ceiling. But from a credit perspective, we think things look pretty good, and we're staying overweight, both high yield and investment grade, looking through to the end of the year.
Meanwhile, we are getting a slew of data from the United States, the latest being PPI, which does signal inflation is cooling. Jobless claims also climbing to the highest level since 2021. All of this giving people some confidence about a Fed pause. Bloomberg's Michael McKee joining us now. Mike.
Well, Lisa, I think you got to take jobless claims with a little bit of the old two-handed economist thing, because a lot of economists are saying the big jump we saw to 264,000, a 24,000 jump in 1 week, is largely due to seasonal factors. Maybe we'll see if that continues, if it goes down in coming weeks, but we certainly have had a lot of layoff notices that should start to show up in the data. And the rise is suggesting that maybe we're seeing a weaker labor market, and that is going to feed into the market perception of the Fed being done, if not cutting. PPI does the same thing. It comes in at a very low level on a month-over-month basis, not the negative numbers we saw last month, but at least a low level. And on a year-over-year basis, the headline 2.3, and for the core 3.2, both of those the lowest, as you mentioned, Lisa, for some time. PPI core ex-trade 3.4%. That shows you that margins are starting going to compress as well. And people talking about, are we seeing disinflation? Tom asked me that in surveillance. I said yes. John Riding pushed back. But if you look at these numbers, it does suggest that we are seeing the Fed with success. We're not there yet, but almost all of the inflation indicators are trending down. And Lisa, I'd point to the white line down there. That's the Atlanta Fed. They do a survey of business leaders and what they think prices are going to be. So along with the producer price index, you can see that they think prices are coming down, the business price index from the Atlanta Fed. And that would also feed into this growing narrative that the Fed is at least done.
Mike, wonderful. Thank you so much, as always. Lindsay, I just want to pick up on what you were talking about, and frankly, Zachary is overweight in credit land. Do you agree with that? Do you think that credit can withstand some of the turmoil that you're expecting in stocks, despite concerns about growth?
I think there are a few things that Zach said that I agree with, and maybe a few that I disagree with, which makes the conversation fun, right? So in terms of carry being king, I totally agree with that one. We have great opportunity for carry, yield, spread, however you want to call it, in the investment grade market. High yield, we're kind of at average levels there, but still there is some to be had and overlay active management, and that works well. But I think something interesting, Zach's pointing out that he thinks that inflation is actually quite sticky and quite concerning, ... probably means that the Fed would have to be more aggressive. That's actually not where we stand. We think that the Fed is going to actually cut because we think there's a decent likelihood of recession. That actually makes us feel like credit right now, it's about having the right spots, picking the right names, and it isn't just, let's just be overweight investment grade, let's be overweight high yield, because the market from an economic perspective is in a good spot. We have some concerns about that economic macro backdrop, and that goes back to finding the right names where there is good carrying yield, but that you actually really believe in the balance sheet.
Zachary, your response to the idea of rate cuts by later this year?
We're not calling for rate cuts because we think inflation, while it is coming down, I agree. I think the trends that we're seeing on the core goods side, like I mentioned, are concerning, but we think economic growth is going to remain positive. And so when you think about the Fed's reaction function in the past, they've been able to respond to volatility or slowing in economic growth very quickly with rate cuts in the past, because we had inflation at 1.5% to 2%. We're still around 5% on many measures of inflation, whether you're looking at year over year, core prices, looking at a 3-month annualized measure. And so we are a little bit concerned on the inflation side. We think the Fed's on pause for now, but we're not calling for a rate cut. At the end of this year, we think that could come into the equation in 2024.
Right now, we are seeing the S&P at session lows down 0.3%, as I guess bad news is bad news, the idea of an economy weakening. What's interesting is the divergence between the U.S. and what's going on overseas. Earlier this morning, we got the Bank of England coming out, upgrading their projection. You hear a lot of hawkish proclamations from the ECB. Lindsay, from your vantage point, do you see this bifurcation opening up right now between the U.S., UK, and the rest of Europe, in the sense that they're just far behind in fighting inflation, but also have a stronger economy at this point relative to the U.S.?
Yeah, it's a great point. When we've looked out on the investment landscape and where we want to invest this year, our focus has absolutely been in the U.S. I mean, the reasons of high inflation in the U.S. are very different than what you see in the U.K. and Europe. So that kind of started things for us about looking differently. And sure enough, you see in the U.S., we're probably likely to pause. And to your point, there was a 25 basis point hike this morning. If you look at inflation expectations in the U.S. as well, a year out, and this is really amazing, it's happened in pretty much the past 2 months since the beginning of the banking flare, we have seen inflation expectations drop about 100 basis points for the next year. So there is just a very different market dynamic, different economic backdrop. And so when it comes to where we want to invest from a credit perspective, really finding the most opportunities in the U.S. because of everything you mentioned.
Zachary, final word?
We're also more focused in the U.S. We've had a market perform rating on European credit. And so we think that while economic growth has been resilient so far, we think when it comes to the winter, concerns around energy prices flaring back up, we think those economies are a little bit more vulnerable to that. And so we like staying focused in the U.S. and our relative value perspective.
Lindsey Rosner, Zachary Griffiths, both of you are sticking with us and just staying on the central banking theme and the cross currents. Neil Kashkari was a dove, then a hawk, now maybe getting a little more dovish, saying that wage growth has softened somewhat, even though the job market is strong, and then also saying that bank turmoil could be a source for slowing the economy. So this question around that as well. Let's take a look right now at the stocks moving ahead of the opening bell. Here is our own Abigail Doolittle. Abby.
Well, Lisa, let's take a look at the shares of Disney because they are weighing on the major indexes, down about 7% at this point, or excuse me, 6%, the worst day of the year. This, of course, as their second quarter Disney Plus subscriber miss weighs. They're also talking about the idea that the loss for streaming in this current quarter will be about 100 million wider than expected due to marketing costs. Investors not liking that. They wanted something more. Relative to JD.com, those shares are popping higher. Sandy Zhu, the finance chief, is to become the new CEO. Analysts say this could mean a strong strategy change to help against competition. Microsoft down 0.5%. The UK has continued to freeze that deal with Activision. And yesterday, speaking of freezing, Microsoft has announced that they are freezing salaries due to uncertainty. Alphabet, on the other hand, up 2.6%. AI advancements have the stock up. New hardware as well at the annual developers conference as it was revealed. And then finally, Lisa, PacWest plunging, as you know, down 23%. This on the news that deposits fell 9.5 last week on talks of a potential takeover. That stock down with that trend. And I should mention, we also just had some breaking news on Peloton. Those shares plunging down 7% as the Consumer Product Safety Commission has recalled 2 million exercise bikes due to fall and injury hazards.
Abby, thank you so much. Coming up, Jamie Dimon giving the regionals a bit of confidence.
The regional banks, who I've been speaking to like every day for the last week, they're quite strong. You know, they're quite worried because of the run on deposits, all that, but their financial results are good. Their financial results are going to be good, okay, next quarter.
But looking at the market, sentiment seems to be moving ahead, a different direction. That conversation is still ahead.
Show the product intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The regional banks, who I've been speaking to like every day for the last week, they're quite strong. You know, they're quite worried because of the run on deposits, all that, but their financial results are good. Their financial results are going to be good, okay, next quarter. You know, they're earning money. They got very good clientele, very diversified, and they're quite strong. If you look at the detail, the SEC has the enforcement capability to look at what people are doing by name in options, derivatives, short sales. And they should go, if someone's doing anything wrong, people are in collusion, or people going short and then making a tweet, about a bank, they should go after them, and vigorously.
That was JP Morgan's Jamie Dimon in an exclusive conversation with Bloomberg's Francine Lacroix. Meanwhile, PacWest coming back under pressure and dragging the regionals down with it. The bank revealing deposits dropped nearly 10% last week in just 1 week. Fueling the flight was a Bloomberg report confirmed by the lender detailing talks with potential investors. In a regulatory filing this morning, the company said, quote, the news headlines increased our customers' fears of the safety of their deposits. For more, Bloomberg's Sonali Basak joins us here in New York. Sonali, what's new and what's causing all the concern?
Now, listen, a couple of days ago here, when we thought about PacWest, it was the fundamentals that weren't a problem. It was really the market that was the problem, the sentiment around the regional banks. But now we have an instance in which the market is creating fundamental problems, in which you're seeing deposit flight from the likes of PacWest. Now, they have a lot of cash on hand, and from the regulators' perspective, as well as other bankers, the idea here is that they have enough on hand to really make it through the storm, even with some deposit flight. But should that number keep getting worse, that's where you have further future concerns. And there's this whole other concern about their cost of funding and how much they have borrowed from the Fed. Now, Western Alliance, conversely, has said deposits are up after PacWest has reported a drop. So now we are getting to the point where we're parsing the regional banking system bit by bit. You heard Jamie Dimon. He said he has been on the phone constantly for the past week with regional bank CEOs. That shows you we are not yet out of the woods, but we are not at the point here yet of potential cliffs facing these banks.
And the implications of that, Sonali, will be discussed for weeks and months to come. Lindsay Rosner and Zach Griffith still with us to discuss just some of those issues. Zach, from your vantage point, how much are you still looking at regional banks as an opportunity point versus the other sort of less optimistic prospect of an area of hurt for a while longer?
Lisa, we really see it as an opportunity, and we've been in that camp for a while now. So when we think about the fundamentals underlying these banks, they're very strong. You've had a few banks go under that had very idiosyncratic and clear issues with their customer concentration, with the quality of their deposits. And we've learned a lot about how quickly deposits can move in this technology, in the era of technology that we're in. And so that's certainly a concern. And really, when we think about what we're dealing with now, it's a crisis of confidence. That's something that we've been saying for a while. We think that once we can get some, I guess, break from the volatility, break from the headlines and the focus on this, whether it be a short selling pressure on the equities, we think that when we look at least credit, bonds right now are going to have a lot of opportunity for spread compression from here.
Lindsay, from your perspective, do you agree?
We feel differently on this. There is no need right now to have to invest in regional banks. Just because something widens doesn't mean you need to buy it. Back to the idea of bifurcation, really parsing apart who are the winners and who are the losers in this context. I'll throw out a phrase of super regional. There are some bigger players that we think will do well and have been thrown out baby with the bathwater that we are looking at adding to. But just because regional banks writ large are wider is not something that we're running to. There are a ton of opportunities right now in the fixed income market. We've talked before about agency mortgage-backed securities, for example, where you can get a lot of spread and have the safety. So we don't feel that we need to go to this spot in investment grade. And I think there's so much desire to jump into things that are widening. For example, there are a lot of people pounding the table about T-bills around the X date. You've got 100 basis points extra of spread, go buy it. There's no reason to do these kind of things where there is an abundance of opportunity elsewhere. And we have the ability to kind of look at that whole landscape and find those opportunities, and we're finding them.
Zach, what's your thought on that? Basically, this idea that spread widening isn't a buy signal at this point.
Well, I'd say at least on the T-bill front, I think that no matter what, you're going to get paid back by the U.S. government. So that seems like a decent opportunity to me. I think Lindsay's point that credit selection within the regional banks is very important. And we do have a few names that we like and a few that we don't. Fifth Third is one of our top picks. We like Huntington Bank shares from here. And so I do think that her point around credit selection is important, and I would say that broadly even within our overweight recommendations. You're going to have to pick your spots here, but in general, we see the spread widening as an opportunity if you want to take a look at it from an index level perspective.
Lindsay, from your vantage point, would you say it's a crisis? Would you say that this is sort of another shoe to drop on a long list of shoes that are sort of cascading as we hit something that isn't a soft landing, or would you describe it differently?
Lisa, I'll go out on a limb and say that you and I are probably the expert on shoes in this threesome conversation.
Fair.
But yes, this is another shoe to drop. Will there be more? We're hoping that we're at the end. I mean, the banks that I think are troubled right now are banks that we were aware of in the apex of this crisis flare, whatever you want to call it. I think the terminology around it is difficult. I don't know that we have the proper lexicon at this point to determine what to say here. But what I think is clearly a crisis is the crisis of confidence. That is a real thing, that your average American does not know where to put their money, whether that is at a bank they're concerned about, in the T-bill market because what's going on with the debt ceiling. That is a crisis. That is real. Whether we call a few banks, but obviously large asset amount, going under a full-fledged banking crisis, I'm not sure. I'll leave that to the historians and the economists. But I definitely think the crisis of confidence is something true that we need to talk about.
Lindsay Rosner, Zach Griffiths, both of you, thank you so much for being with us today. And coming up, the morning calls. Later, a brace for a new bull market. That's the view from TPW's Jay Pulaski, expecting stocks to break up and out from here. We'll catch up with him around the opening bell.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, Piper Sandler downgrading Mosaic to neutral, pointing to bearish crop data that could hit sentiment on fertilizer stocks. Credit Suisse next, upgrading Alcoa to outperform, naming it as a top pick. And finally, Goldman Sachs downgrading Twilio to neutral. Coming up, we'll get the markets open. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, losing steam heading into that open. The S&P futures near session lows down almost 0.3%. You could see NASDAQ holding on to a little bit of a gain, but losing it, and the Russell really losing more steam simply because what we have seen is in the bond market, yields lower, and you could see a softer tone more broadly. New York crude lower, almost getting close to that $70 threshold, $71.50, and that 10-year yield 3.36%. A little bit of dollar strength, euro weakness 109.18. One stock to watch at the open is Disney. Shares slipping at its streaming service lost subscribers for the second straight quarter. The C-suite warning of more losses to come. Bloomberg's Abigail Doolittle back with us for more.
Hey, Lisa. Well, you know, it's interesting because the subscriber miss, that has everything to do with the fact that the company, or most likely has everything to do with the fact that the company raised prices last December to $11 for a month of streaming. And Bob Iger, the CEO, said that they're planning on raising prices again. But what has the stock down, in addition to that subscriber miss, is that while the quarter that they just reported, the second quarter, it was a strong quarter. It was in line with numbers outside of that streaming miss. They narrowed the loss for streaming, but now they're expected to tack on another $100 million in terms of the loss, so it's expected to go wider. They're saying it's a blip because of marketing, but when you put all of this together, that investors clearly not liking the results right now. It's also interesting in the fact that over the last couple of years, this stock down in a big way. This year it's higher, but kind of caught in a range. When you compare it to Netflix, on the other hand, Netflix is more than a double over the last year. So Disney investors really want to see them work these issues out, hope that the return of CEO Bob Iger can maybe do it. Maybe they wanted more fireworks in terms of color commentary. They didn't get it, so they're focused a little bit on some of these blips, according to the company, around streaming.
Worst day since November 2022, if it holds. Abigail, thank you so much. Another earnings story. JD.com shares rising after reporting better than expected results and announcing changes in its C-suite. Bloomberg's Katie Greifeld joining us now for more. Katie.
Definitely a surprise move. So this shuffle comes just a year after the outgoing CEO took the job, and it also follows JD.com's slowest pace of growth on record. The Chinese internet retailer actually beat projections. Revenue grew by just 1.4%, so a beat, but not big enough. Remember, this company was putting up double-digit growth numbers just a couple of years ago, of course, before Beijing clamped down on tech and internet companies. So this personnel change, elevating the current CFO to CEO, analysts are saying that this suggests that JD.com is really shifting its focus to profitability. And you can see that shareholders seem to be welcoming that news. ADRs of about 6% at this moment.
Katie Greifeld, thank you so much. And speaking of tech, there is no day they can go by without a discussion about artificial intelligence. Google asserting its dominance in the AI market, unveiling its latest tools and setting shares higher. The CEO is saying the magic words, quote, "We're at an inflection point. We have an opportunity to make AI, ding, 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 even more helpful for people, for businesses, for communities, for everyone." Joining us now is Kaylee Lyons. Kaylee, is this basically just saying the magic word and then shares pop?
Yeah, maybe, Lisa, because you did see the stock gaining 4% yesterday on the day of the developers conference and up again another 3% this morning. If there is anything we have learned in 2023, it's that investors really get excited when AI is mentioned. So Google is doing this rollout of generative large language models in its search engine. I would note, though, that it's doing it quite slowly. This update is only going to exist in Search Labs, which is a new experimental space that users actually have to sign up on a wait list for. So they aren't rolling it out broadly, unlike, for example, Microsoft Bing, which has done so much more quickly. We have to keep in mind, though, what Google stands in theory to lose. Bing has a very, very small slice of the search market, whereas Google is dominant. It is literally a verb, so perhaps there's a little bit of hedging here. All that said, analysts today seem pretty positive on the speed at which Alphabet and Google are doing this. Morgan Stanley saying they're doing so faster than expected. KeyBank saying the event showed the company is moving swiftly. And also separately from that, AI is probably what is getting investors actually really excited. But they also introduced a foldable smartphone, which makes me kind of nostalgic for my flip phone, Lisa.
Kaylee, we'll let you be nostalgic. Thank you so much. Let's go over to one of the more important stories of today, frankly, which is the regionals. The sell-off has resumed in the PacWest shares, with the bank saying that its deposits declined by nearly 10% last week. Joining us now is Bloomberg's Sonali Basak. Sonali, how significant is this sort of decline in such a short period of time?
It's significant because we know that this sector is already treading on ice. PacWest shares the brunt of those concerns. Lisa, when you take a look at it, into this morning, it was trading at about 26% of its book value. When you look at that compared to the worst performers in the KBW Bank Index, those banks, even the worst performers, are trading at almost 60% or more of its book value. Still under book value, but a significant discount when you look at PacWest, and you see those fears reflected in how their bonds are trading as well. Now, PacWest this morning has been paused due to volatility, but they have been down pretty significantly, almost 29%. Western Alliance, which came out with its own statement on Thursday morning, saying that its deposits are actually up, it is still also down in early trading about 5%. So you can see these fears persisting even for banks that are showing you that they're bringing deposits in or holding deposits stable at this time.
Just can't get the shares to bounce, and you can see that in the KBW index as well. Sonali Basak, thank you so much. JP Morgan's CEO Jamie Dimon laying out how markets move forward from here.
We need to finish the bank crisis. We've had uncertain policy on mergers, this First Horizon deal. I think we have to assume there'll be a little bit more. Yeah. So, whatever the FDIC, the OCC, the Federal Reserve, whatever they need to do to make it better, they should do. Be thoughtful, be very forward-looking, not be surprised constantly, because some of these things have been known about for quite a while.
The first order of affairs was simply getting through the crisis. TPW's Jay Pulaski joining us now. Jay, what do you make of that? Do you think that it is really seeming to be a cascading sequence of events in the regionals, or is it something more benign?
We're in the more benign camp, Lisa. We wrote about this in a piece called Firebreak when SVB first failed, that we actually think this is a net positive in that it really takes the Fed off the table and prevents the Fed from over-tightening and really damaging the real economy. And as long as this is kind of maintained or contained, let's say, in the regional banks, we think that's going to be okay for the overall economy. And we look at things like the impact on credit, for example, because really the concern is that we get into a credit crunch, right? But we look at the spread of high yield over Fed funds, and right now it's about 200 basis points. And when you typically have a systemic crisis or systemic risk, that spread blows out to 400 to 500 basis points. You look at the VIX, for example. The VIX is at 16, showing no signs of concern. You look at the MOVE index for U.S. Treasuries, 125 today, no sign of real concern. So I think the market has correctly assessed that this is an issue for some banks, clearly, and we really think it's an addition to what we call the curtain of FUD, fear, uncertainty, and doubt that's really masking some major positives that we see unfolding in the U.S. and around the world.
Okay, there's a lot there to unpack, and I want to start in the idea that the banking turmoil takes the Fed out of the equation. Earlier today, Neil Kashkari of Minneapolis was speaking at an event at Marquette, Michigan, and basically saying inflation is still too high, and this is what a lot of people are saying after yesterday's CPI report. What makes you think, especially if we see the calm ongoing in the banking system, it will be enough to really change an equation for a Fed still trained on inflation running above 5% on a core level?
Yes, I think that's an excellent question, Lisa. And we've been talking about a middle path between high inflation and recession. That's really been our kind of guideline or direction for the past year. And we think we're moving in that direction. We expect the next several months to be very benign inflation prints. The year-over-year comps are very compelling. Inflation a year ago in May and June was roughly 1%. We think it's going to be about 0.4% for May and June of this year. That brings the headline number down to well under 4% by June. We think the market is correctly assessing the Fed is not going to move in June. And we expect the Fed to actually raise its economic growth outlook when it updates its inflation and growth estimates in June. And we think those could be some of the positive catalysts that we're looking for to help the stock market break out and up from what's been a very long, historically very long trading range.
So from the SLOOS to the SEP, the Statement of Economic Projections that we get, I believe on June 14th, when the Fed does come out. One thing that you've been positive about, Jay, that you were talking about with respect to these shoots that are revealing themselves has been China. And you've been pushing back against some of the people that have been removing from that nation, saying that's an opportunity. However, we did get data overnight about credit contracting. Are you still as optimistic, or do you think that that trade has basically been played out?
No, that's, again, a good question. China's been a disappointment from a stock market performance for sure. It had that big run after they removed zero COVID in late 22, and stocks popped significantly, and they've given a lot of that back, even though growth estimates have been revised up considerably, and most people are now at 6% growth for China for 2023. And it really reinforces our view, Lisa, that we're early cycle, not late cycle in a global economic recovery. And when you look at things that have been dragging down growth, for example, housing or inventory destocking in the U.S., those things are shifting to be growth additive in the second half of the year. And stocks are telling you that, right? When we look at our global multi-asset model, the two best performing positions over the last month have been transports and home builders. So while China's been a disappointment itself, and it's been a disappointment, it's kind of impacted commodities as well. We think globally we're in the early stages of a global economic recovery, not late cycle going into a global recession.
Going forward, what is sort of the threshold that you look for to understand whether the economy is keeping pace with your expectations? And I ask this because the data is so noisy and people are coming up with different stories to define the data points that we get. What's sort of defining for you?
Yeah, no, again, 100% right. I mean, Stan Druckenmiller, one of the greatest investors of the modern age, said it's the most confusing period of his career. So, you know, who are we to argue, right? And I think a lot of that is this curtain of FUD. And the latest iteration of that is the regional bank crisis. We're focused on four major global policy changes that we see unfolding on a regular basis. The first is developed market central banks accepting a high nominal growth world by shifting their inflation target from 2%, say, to 3%. That's key. The second is the return of industrial policy to the U.S. and its expansion in Europe. One of the reasons why people are confused, Lisa, is that we haven't had industrial policy like the CHIPS Act, the Infrastructure Act, the Inflation Reduction Act, all of which are starting to funnel into the economy. We haven't had it in the U.S. in 70 years. So no investor today has any real grasp of how that impacts economic growth. The third is the end of yield curve control in Japan. We think that's going to be huge. And we think Japan is exiting structural deflation, going to lead to a big asset allocation shift within Japan to stocks. Japan is breaking out Check out EWJ, just breaking out, new 52-week high. And then the last is China related in the shift to domestic demand away from fixed asset investing and export-driven growth. And that's huge for China.
Jay, we'll dig into some of that in just a minute. Jay Pulaski is sticking with us, and we are going to turn our eyes toward everybody's favorite topic, which is the debt ceiling debate and what's going on with policy, as Jay was talking about. Secretary Yellen out with another warning for lawmakers.
A default is frankly unthinkable. America should never default. It would be tremendously economically and financially damaging.
That conversation coming up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Default on U.S. obligations would produce an economic and financial catastrophe. Millions of Americans could lose their jobs. Household incomes would be reduced. American businesses would see credit markets deteriorate. And millions of American families that receive government payments would likely be left without the resources that they were promised.
Secretary Yellen doubling down on her grim message for Congress. The debate coming to a head as President Biden and congressional leaders prepare for yet another round of negotiations. The president taking his appeal on the road and throwing some punches.
Republican threats are dangerous and they make no sense. If we default on our debt, the whole world is in trouble.
This is a manufactured crisis. There's no question about America's ability to pay its bills.
This coming as former President Donald Trump tells Republicans to hang tight, even if it means default.
I say to the Republicans out there, congressmen, senators, if they don't give you massive cuts, you're going to have to do a default. And I don't believe they're going to do a default because I think the Democrats will absolutely cave because you don't want to have that happen.
For more, Bloomberg's Kayleigh Lyons joining us from Capitol Hill. Kayleigh.
Well, Lisa, the former president may be giving some sitting congressional members of Congress cover to take this to the brink or beyond. And I have had conversations in recent days with several Democratic members, including Representative Jerry Connolly as well as Don Beyer, who both indicated to me that they do think there are members of the House of Representatives who would be willing to let the country default. And for that reason, they are more concerned in this debt ceiling crisis than they have been in any before. All of that said, though, it doesn't seem like it has led to much of a strategy shift on either side. Both parties still pretty much towing the party line, sticking to the talking points. Democrats are willing to negotiate over spending cuts in the appropriations budget process, whereas House Speaker Kevin McCarthy and his caucus would like to see spending cuts as a condition for raising the debt ceiling, as was done in the bill that they were able to pass several weeks ago. All that said, there does seem to be some sign of forward progress. Yesterday, aides from the White House and congressional leaders did meet. They will do so again today to talk about what spending cuts could be on the table. Again, though, it is unclear that they think they are talking about the same thing, whether those spending cuts are part of a debt ceiling package or a budgetary one. But of course, this is trying to lay the groundwork, find some common ground ahead of that meeting taking place tomorrow, again, with the big four, McCarthy, Schumer, McConnell, and Jeffries, taking place at the White House with President Biden, who, of course, hasn't just been sitting by in the Oval Office waiting for that meeting. As you said, Lisa, he took this message on the road into swing territory yesterday, trying to lay on some pressure as the clock is ticking rapidly toward that theoretical June 1st deadline.
Kayleigh, thank you so much for that. TPW's Jay Pulaski back with us. Jay, how prepared are you for the U.S. doing a default?
Not very, Lisa. I think it's highly unlikely that it's going to happen, and kind of the threat that it's likely to happen would be, I think, probably one of the last and best buying opportunities for that market break up and out that we expect. And one of the reasons why one, I don't think, has to prepare significantly in terms of rapidly adjusting their portfolios is because bonds are already priced for recession and stocks are positioned for recession. You look at sentiment, you look at cash, you look at people, number of people overweight equities, whether it's retail or institutional. You know, we are at almost generational lows in terms of investor sentiment. And that's one of the reasons why I think, notwithstanding the headlines on this day after day after day, stocks are perfectly fine. Volatility indices, like we talked about, perfectly fine. And so I think the market is sniffing out an economic recovery, earnings estimates going up, corporate guidance going up.
Hold on a second, Jay.
We're discounting looking mechanism, and that's what it's focused on.
I want to really parse out what you just said. You said that sentiment was already so depressed, and so that's why equities aren't really responding. They're looking toward a recovery. Are you saying that a default is all but priced in, that if we get close to that, there won't be some sort of reaction?
No. If a default actually occurs, then yes, there will be a reaction. It probably would be a buying opportunity. The threat of a default, if it leads to 3% pullback, a 5% pullback in the S&P, would be a buying opportunity, because let's face it, even if there were to be some sort of technical default, the likelihood of it being resolved imminently, I think, would be very high. In the history of how markets react, particularly today, where so much is quantitatively driven, is that as soon as you have that peak fear, the market prices it in and moves forward. And we saw that with COVID, and we've seen that multiple times over the last couple of years with whatever the crisis of the day is. And so that would be how I would think about it. It's extremely unlikely to happen. If the market weakens in anticipation of that, that's probably your last best buying opportunity for what's going to be a second half that's going to have better growth, higher earnings than most
Hold on
expect.
a second. Jay, I know that you're bullish. I'm just wondering, is there anything that could make you bearish at this point that you could see in the data?
Yeah, absolutely. We watch earnings very carefully. if the earnings estimates were being cut as opposed to being raised. We pay attention to forward corporate guidance, which we just got with with the earnings for Q1. If that were to be negative, that would be a real warning sign for us. In fact, it's been very positive, the most positive in a couple of years. So yes, there obviously are things that if we were to see, we'd be worried about and think about repositioning. And we are overweight non-U.S. equity, Lisa, as you know, and have been for over a year. Europe is breaking out, Japan is breaking out, Mexico is breaking out. There are breakouts happening all around the world. And so the opportunity set, I would agree with you, is not necessarily in the U.S., it's outside the U.S., and that's certainly how we're positioned.
And a lot of people agree with you, and it has been a really good trade. Jay Pawlowski, thank you so much for being with us. It's always fun. I always appreciate your insights. Coming up, the market-moving events that you need to be watching. That's next in our Trading Diary. This is Bloomberg.
'Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
25 minutes into the trading session, and it has gone lower, decidedly so. Even the Nasdaq's joined some of the sogginess, down about 0.1%. The S&P currently 41.12, and we can see that down about 0.6%. Let's take a look at bonds. You can see those yields are also falling lower. Time now to see the trading diary, what you need to be watching through the next week. Fed speak continuing Friday with Daly, Bullard, and Jefferson all on deck. Plus, look at the UMich Consumer Sentiment Survey down in D.C. President Biden, congressional leaders resuming debt limit talks. Looking ahead to next week, the Senate Banking Committee holding its hearing on SVB on Tuesday, and Tesla kicking off its annual shareholder meeting. This was Countdown to the Open. This is Bloomberg.
big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in prize source every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade came through the window. 3 Pepsi employees. Mario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the